Perfect. Yo, what's up, guys? I know a lot of people are making a lot of money out there today. Specifically, the Mag 7 biggest stocks in the whole market are going crazy today. And I really called this yesterday. We have Meta up 6.5, Amazon stock is up 5%, Oracle's up 5, Google's up 5, Microsoft's up 5. I mean, this is a phenomenal day for the Mag 7 and the S&P 500. So I'll start the stream off by doing a quick stock portfolio update. Then we'll check out all the stocks that you guys have. Hope everyone's having a good day. It's hard not to be having a good day when the market's rallying so much. So here's my Webull portfolio. Hey, we're over $20,000 finally, and open profit and loss. I love being fully transparent. I go to a lot of other streams. No one shares all their purchases, their lifetime performance, and all that. And I like being fully transparent. I'm only up 31% all time in here, which isn't too shabby for this portfolio. Here are today's biggest movers. Looks like CF, AbbVie, kind of the defensive names are down. Yeah, regulated utility. But then it's like software stocks and fintech are rallying, like Dave, Microsoft, Reddit, SoFi. Yo, we literally just bought 2 more shares of SoFi at $15, literally 3 days ago on that candlestick. So right after earnings, I freaking love SoFi. I got Robinhood's up 5. AMD's actually surprisingly green. AppLovin, that's our Webull portfolio, and here are literally my most recent purchases in their exact order. I just bought Citigroup literally not that long ago. There's a little B right there. That's my buy order. Just bought them for the first time ever. This is a pretty cool dividend growth stock. Even if you buy it after this rally, you get over 2% of your money back just in a qualified dividend every year. They only trade at 11 times forward net income or next year's net income. I think that has the potential to just continue to rally, especially with that low valuation. Next up, this is what's crazy, our dividend-only portfolio, which of course means once I buy a stock, or every stock in here must pay a dividend. These are all the stocks that we own in here, and of course, led by Google's at up 5, Meta's up 6.6, Constellation Energy's up almost 4%, so we're having a phenomenal day. Year to date, we're still underperforming the S&P 500. Over the past year, we're up 8%. Year to date, we're up 2.6%. And here's our lifetime gain on every stock. So the only company we're slightly down on is McDonald's, which I'm not too worried about. It's really all the restaurant stocks that are struggling. Like, did you know Wendy's is below their 1997 IPO? A lot of these QSR quick service restaurants are really struggling. And then we have a Roth IRA as well. A Roth IRA is just a tax-free retirement account. So we kind of made this exactly a year ago. We're not doing too hot. We're down 4% since we started this. Like the first couple months, there was like $50 in here, basically nothing, but I've deposited a lot more money, and we kind of keep it simple. We got 4 stocks in here. We got 7 stocks in here. I know I got way too many stocks because this is now my final portfolio here. This is called my buy and never sell portfolio, where once I buy a stock in here, I literally am never allowed to sell it. So if you come back to my channel in like a year or something, we will own all these exact same stocks. And one big news today, my second largest holding, Powell Industries, POWL, it's over 10% of my portfolio, reports earnings today in literally 4 hours. In 4 hours, we're going to get earnings, and that's going to move my portfolio a big chunk. I'm really excited about that company. And open profit and loss, we're up 30K all time in here, and it's really from our never sell strategy. Like, it's been tempting, up 700%, up 16K on this stock. It's been tempting to sell, but I'm literally not even allowed to trim a little bit. But here's what's crazy. Amazon just hit a crazy all-time high today. I've been shilling Amazon forever, saying this is a great buy and never sell stock. Every time they dip, I continue to load the boat on Amazon, and they just had phenomenal earnings, their best cloud growth in like 18 quarters. So I freaking love Amazon. They own Zoom. This is an ETF in one. I won't even give my pitch on Amazon. Everyone knows they own Whole Foods, Twitch, obviously the subscription model of Amazon. They're the second largest satellite company right behind SpaceX. Amazon files application to deploy another 5,100 Amazon LEO satellites. And here's a really bullish thing for the stock market, and specifically Mag 7. Morgan Stanley projects a 25 to 50% return on invested capital on AI infrastructure. So a lot of people are scared these companies spending crazy capex, but they're saying that using GPU leasing, that gives a 31% ROIC. Proprietary models like training your own LLM, 46% ROIC, and third-party infrastructure model is a 25% ROIC. So that's actually great news for these companies spending massive capex, and it's kind of their strategic moat. No other companies can really catch up to their spend. So, all right. Where do you think Amazon will go within 2 to 3 years? So here's what's crazy. Even though Amazon is at an all-time high right now, it's never been higher. The valuation is still like fair. I mean, it's at a 29 forward PE. That's not even ridiculously expensive. Like it'd be a different story if they were at like a 35, but a 29 times next year's net income. Honestly, like as they grow their EP, that's assuming they don't beat on net income, which they historically like always beat on their profitability metrics because they're cloud business. But 29 forward PE, honestly, that's fair. I would not trim or sell my. If you had Amazon, don't trim or sell it. It's going to continue to climb higher. And what's up, Brandon and Mr. Gurdon? How's everyone doing? I see GameStop. What's up, Sal? I want to try and get to all these stocks. I'll start with the first stock I saw, which is Echo. Oh, EchoStar. This is kind of like another satellite play. Amazon just bought GlobalSat. EchoStar is another one that is a satellite company, I believe. Or no, never mind. I don't know. Well, let's see here. Oops. It says the industry for EchoStar is pay TV and then wireless. So how's their TV business doing? Yeah, so this is the one thing, cable television, that's kind of just going to decline single digits for the rest of the time. Like this is really bad. It's down 10% after it fell 7, after it fell 8. So what about their other businesses? Their wireless business, that's flat year over year. So that's the one scary part, the sales, the lifeblood of the company. Look at this. I mean, this is really not what you want to see. It's just like it continues to fall. Like it's not growing, it's actually negative. Down 5% after it fell 4, after it fell 8.5. Are they profitable? So they're not profitable either. If we zoom out for the past 6, 7 to 20 quarters in a row, they haven't made a single dollar of profit. They lost 150 mil, 1 billion, 12 billion, 300 mil, 200 mil. So that's the one kind of scary part. I mean, nothing's really blown me away here. Looks like they're quite leveraged as well. So honestly, I know the stock is rallying because the whole space sector is rallying because of the SpaceX IPO. But out of all the satellite companies, honestly, this one's not really impressing me. Yeah, revenue's even forecasted to continue to decline. So I don't know about that one. Amazon, you can just own Amazon and get exposure to that great industry too. Okay, how about the GTA stock? You're talking about Take-Two Interactive, and then we'll look at Caterpillar. Yeah, dude, that's a great company benefiting from the construction of data centers. So here's Take-Two Interactive. Yeah, this is the company that owns GTA 6 or GTA 5, and as everyone hears, they're about to release GTA 6. They're in a very unique position where like they're about to release a game that's going to be a top 10 game of all time. It's as soon as they release this game, that's hundreds of millions and billions of sales. But there's one thing to be worried about, and that's profitability challenges. If we zoom out, this company, and like I hate to be bearish, but like they have not made a single dollar of net income in years. Look at this. Like this is the after-tax net income. All they've done is lost cumulative like $10 billion for the past 3 years. And that's kind of where Morningstar's saying to stay away. They're saying they're overvalued. While the highly anticipated release of GTA 6 will undoubtedly drive massive revenue growth, the market is pricing in unrealistic long-term growth expectations that ignore the inherently choppy nature of the firm's sporadic major game releases. And the net income is a little scary. Let's see, is there any other news? Reports fiscal revenue net loss narrows ahead of GTA 6. Yeah, they're still losing. I wonder, 1.6 billion in cash after paying off 1.15 billion in debt. So GTA 6 is scheduled to be released on November 19th, 2026. So anyway, are they projected to make net income? I mean, they're only going to lose 42 mil next quarter, but then they're going to lose 116 mil. Honestly, nothing's really blowing me away there, sadly. But here's a stock that does blow me away. This one's really impressive. This benefits from the construction of data centers, also the just onshoring of manufacturing back to America. We're building factories again. That was kind of the whole point of tariffs. We rely too much on like China and international markets to supply us with certain things like rare earth minerals. So they are also, Caterpillar is really benefiting from construction of mines, rare earth mineral mines. So yeah, the construction industry is 42% of the revenue, power and industries 40%, and the resource industry is 21%, and they have been crushing expectations. So this is why the stock has just done so well. It's because they're genuinely beating on their numbers. The orange line is what the analyst forecast. They expected 16.4 billion of revenue. They did 17.4, and not just a beat on their revenue, but a beat on their after-tax net income. And this was real. They expected 2.16. They did 2.54. Even on EBIT, they beat earnings before interest taxes. So this wasn't like some accounting trick. They genuinely, like for the past 3 quarters in a row, crushes expectations. So honestly, this one's interesting, but they look a slight bit too expensive. A 32 forward PE or 32 times next year's net income. That's still now's not the time to buy meaningfully. They are on a little dip, so maybe it's a decent time to nibble, but I wouldn't buy meaningfully at a 32 forward PE. Morningstar does say they're a slight bit overvalued. I don't know if I agree. Well, yeah, slight overvalued. While the crazy demand for power solutions driven by AI data centers and a robust dealer network provide strong structural tailwinds, investors should remain cautious of the stock's premium valuation and the macroeconomic cyclicality and substantial near-term margin pressures from tariff impacts. Anyway, I own another company. It's called United Rentals. This is the company that's also benefiting from the construction of data centers. They basically rent out a bunch of Caterpillar equipment and a bunch of other stuff as well. But yeah, this one actually, even this one's only at a 22 forward PE, even at an all-time high. That's when you know you should not sell a stock, even if you're up a bunch on it. When even at their all-time high level, because the earnings have grown so fast, the forward PE ratio is still cheaper than the S&P 500. So here, I'll show you my position in them real quick. I got 5 shares of United Rentals. They've been a great hold. I'm up 77% since I started my position. I've owned them for over a year, and we get nice little dividends. Check that out. We get like $10 a quarter. Mainly you're buying them for the stock price appreciation, but the dividends are a nice little cherry on top. All right. Hey, what's up? John says good AM, almost PM here. Yeah, me too. It's 11:55. Hope everyone's having a good morning. Just followed you. Honestly, like the way. Oh, what's up, One Piece? Hey, I just got done watching some. Good to see you. I appreciate the follows. Hey, yeah, watch out for people impersonating me. Just had to ban someone with the same name and pictures as me. I sell nothing. I have no course. I literally just on here give my opinion. That's not financial advice. I literally sell nothing. Yo, did you end up buying more Innodata? Can you take a look at APLD? They had earnings recently. All right, let's look at APLD. Ooh, sadly, this one I have not bought any more Innodata. I'm happy with my current position in Innodata. I'm still up. Like, it's hard to buy more when I'm up 93%. But yeah, this is one of my favorite software stocks. A lot of software stocks are falling because of AI fears. This is actually a software AI beneficiary, in my opinion. Anyway, here's APLD. This one I actually would stay away from because what does this company do? To tell you the truth, all this company does is rent out GPUs. They own a bunch of graphics cards, a bunch of NVIDIA chips, and they rent them out. And that is a low moat, no margin, commoditized industry, which is unfortunate. Yeah, so here, Morningstars, what do they say? They say they're overvalued. Although the company experiencing explosive revenue growth driven by AI demand, its severe lack of profitability and a sharply negative free cash flow require significant investor caution. Yeah, that's the tough part. Look at these net income numbers. They lost 111 mil this quarter, 100 mil last quarter, and that missed expectations. They were only supposed to lose 59 mil. They're going to lose 78 mil next quarter, 66 mil the quarter after. That's the net income. And dang, look at the free cash flow. That's what FCF stands for. They lost a bill of free cash flow, 700 mil, 500 mil. So yeah, they have like good revenue growth, but it's it's a bad industry. That's the one part. They actually fell 10% the same day Meta said Meta is now getting into GPU leasing. They have a lot of excess compute, a lot of excess data centers, so they're now actually going to rent out their GPUs as well. It'd be a different story if this company was profitable and making free cash flow. Those are the kind of companies I want to own, ones that make net income, make free cash flow, and forecast it too. But because it's a commoditized, low margin, or really a no margin industry, no barriers to entry, it doesn't seem like a great long-term bet. It could be a fun swing trade. What's this website? Hey, I'm actually on a brokerage. It's just like Schwab, E-Trade. It's actually linked in my bio there if you'd like to check out the brokerage. But yeah, it's actually an affiliate link too, so it'd help out if you sign up through there. But yeah, you can just type it into Google called Moo. So let's see here. Nebius, please, my largest holding. Hey, I kind of have the same thesis on Nebius. I'm scared of the long-term view because, again, this really is just a GPU rental company. And I'm not just picking on APLD. It's actually all these companies. Check this out. They actually had an accounting trick. It says they made 621 mil in net income. Actually didn't. How can the earnings before interest taxes be negative and then the net income be positive? It's an accounting trick. But yeah, look at these net income forecasts. They're going to lose 223 mil next quarter, 300 mil the quarter after. And look at their free cash flow as well. They lost 200 mil, a bill, 700 mil. So it's not just APLD. This is another GPU rental company. They own a bunch of GPUs and rent them out. So that's the only unfortunate part. There's no net income and no free cash flow for me to analyze. But this one could probably still do good through the end of the decade. But yeah, even Morningstar saying this as well. They're significantly overvalued, unfortunately. So the good news is they're up 13% today. And honestly, not financial advice. I would slowly try and get out of this name. But I know he says it's his largest holding, so I kind of feel bad for bagging on this stock here. But it's simply it's an industry in a financial problem. There's no net income, no free cash flow, and Morningstar says they're overvalued. While the multi-billion-dollar hyperscale contracts demonstrate strong near-term momentum, the highly commoditized nature of the bare metal GPU leasing, Lumen AI supply normalization, and impending massive shareholder dilution to fund capex requires extreme caution. And there's also this depreciation, this GPU depreciation thesis, where they have to keep buying the newest chips, and the old chips they have depreciated so much. Anyway, well, that's the. I hate to be mean on that one, but hopefully that was kind of helpful there. Hey, what's up, Kyle? Good to see you. He says SanDisk. Okay, this is the memory shortage sector. Okay, and the memory shortage or the memory sector has had a beating the past month. They went from 2,300 to 1,200 bucks. They lost $1,000. Let's see, is there any news here? Samsung reports strong Q2. Microsoft and Amazon Cloud earnings boost memory sector outlook with supply shortages seen through 2028. That's pretty impressive. But the thing is, it's hard to be bearish, honestly. I'll go over the bull case and the bear case. It's hard to be bearish when they only traded a 6.7 forward PE, and that's real. They really do only trade at 6.7 times next year's net income. Here, the net income forecast. They're supposed to make 5.25 billion of net income next quarter, 6.5 billion the quarter after. It's growing from 100 million. So just massive net income growth. Same with Micron. They're seeing massive net income growth. That's why we do a forward PE. But it's actually the 2029, 2030 estimates. So they're not going to be able to sell this kind of commodity at a 60% net margin forever. So that's the only thing you want to be careful about. But they're starting to get fairly valued. Like it's hard to be bearish. Like the fear's got to be fully priced in at this point. But you got to watch out. Like 2028, 2029 could be peak ever net income for them. Morningstar says they're fairly valued. The AI-driven memory pricing upcycle will drive tremendous near-term revenue growth and margin growth. Extreme, but this is the long-term thesis. This is a great medium to short to medium-term stock, but not a long-term never sell stock. But extreme long-term market cyclicality and a lack of pricing power does require some caution. So that's why I actually wouldn't make this one a meaningful size position, but maybe I'd make it it might even be decent to make a small position as like a short-term trade. Same with Micron. Micron literally maybe these are fully priced in. They only traded a 5.6 forward PE. That doesn't seem like some peak bubble valuation. Like I feel like this could stretch up to like an 8, 9, 10, and that would send this stock up, 50% back to an all-time high, and they still wouldn't even look ridiculously overvalued at an 8 forward PE. Hey, if you're enjoying, hey, thanks. Yeah, drop a like if you're enjoying. I appreciate that, John. Thanks for being a member. And what's up, Plasma? Good to see you, man. So someone said just NVIDIA stock, or yeah, dude, NVIDIA, I like this one. Yeah, hey, James, we literally just did Nebius as the last stock. I would be really cautious on that one. Same with Iris Energy. They're also, if you can go to my YouTube. I'm streaming on YouTube as well. That's actually the best way to support me if you want to. I'm streaming on YouTube, and you can rewind it if you missed it. But yeah, hey, we'll try and get to, hey, what's up, Tom? He says, thoughts on SaaS software like Salesforce? Yeah, well, check out Salesforce. I'm so behind. I apologize. I want to get to all these stocks. Here's NVIDIA, though. This is another one where I'm actually bullish on NVIDIA. A lot of people see this chart and they're like, all right, NVIDIA's done. There's no upside left. The risk to reward doesn't look good. But here's the thing. NVIDIA, did you know this? They only trade at a 20 forward PE. That is literally significantly cheaper than the S&P 500 that trades at a 26. So they only trade at 20 times next year's net income. And look at these forecasts. That's assuming they don't beat on the earnings. They're supposed to make 51 billion next quarter, 57 billion of after-tax net income the quarter after. They sell these, and this is the purest picks and shovels AI play. They're selling these GPUs at a freaking 60 to 71% net margin. If you like Iris Energy and APLD and Nebius, why not own the company? They're like that. Those are NVIDIA's biggest customers. Why not own the company selling the chips to those cloud companies? Anyway, they're making a 60, 70% net margin per GPU sold. Revenue's up 85% year over year. A fortress balance sheet. Huge GPU market share. So it's hard to be bearish. I mean, Morningstar even says NVIDIA's undervalued. Exponential growth in data center CapEx, high switching cost associated with the CUDA software platform, and continuous innovation in AI infrastructure will drive long-term value growth. And I agree. This isn't some peak bubble valuation of 20 times next year's net income. So yeah. What's this app called? Hey, it's a brokerage again. LinkedIn profile bio there if you'd like to check out the brokerage called Moomoo. You can type it into Google too. So, all right. Yeah, hey, we're not going to look at Iris Energy. We basically just covered them. Sorry, but Nvidia's so big they literally own a bunch of individual stocks. Actually, Nvidia just took a stake into Iris Energy. There's a reason Nvidia is buying CoreWeave, Nebius, and Iris Energy. Nvidia's giving them money, and what do they do with that money? They spend it completely on Nvidia chips. So yeah, they actually bought Coherent. Coherent's a phenomenal stock. I actually really like Coherent. But a lot of the companies Nvidia owns are risky, but they own them because they're their biggest customers. Next up. Oh, geez. Oh, yeah. Someone said Salesforce earlier. Yeah, the SaaS sector. So software is really getting hurt by the AI thesis. Like Salesforce isn't missing on their numbers. They're falling because they're saying maybe in 10 years from now, we won't need Salesforce. You can just Claude code, make your own in-house CRM, customer or employee management software, whatever. But what is this right here? Salesforce secures a 1.6 billion AI contract with the U.S. Department of Veterans Affairs. That's pretty interesting. Oh, and yeah, what I love is Salesforce owns Slack. Like over half the S&P 500 companies use Slack. Amazon uses them. Morningstar says they're undervalued. Its dominance in customer 360 software ecosystem and the rapid monetization of new AI capabilities through Agentforce and Data Cloud will drive long-term value growth. And Salesforce only trades at a 23 forward PE. Like is like only 23 times next year's net income. That is very cheap. And they've been crushing net income forecast. They expected 1.65. They did 2.1, and that's real. Even on EBIT was a big beat. So this wasn't like some accounting trick. They really are beating on net income. Like that's the thing. Salesforce isn't falling because they're missing on their metrics. They're falling just because of the sentiment. And here's the crazy thing Salesforce just did in response to this. They just did their biggest share buyback ever. You won't believe this. They pay a dividend. Oh, look at the dividend. Here's another way you can tell if a company did a share buyback. The dividend last quarter cost $390 million. This quarter, it only cost $365 million. How did the cost of the dividend go down? Did they cut their dividend? No, they actually bought back their own stock. They bought back specifically $27 billion of their own stock this quarter. Whenever you buy back those shares, you don't have to pay dividends to those shares. But let me show you how meaningful this share buyback was. So here's another way you can tell. The net income grew by 36% year over year, but the net income per share grew by 52. How did the net income how did the net income per share grow faster than the net income? Well, it's the per share part of the ratio. Obviously, it's the share buybacks. They bought back 20% of the company. Ridiculous. And you get a dividend, a 0.9, basically 1% dividend yield. So pretty interesting there, Salesforce. And check out this revenue growth over time. Like this is impressive. Like honestly, like almost like every quarter, the revenue just hits a new record. So yeah, that's Salesforce. Hopefully that was kind of helpful. I would still be cautious because of the AI fears. Like I really don't know how AI will impact them. So yeah. So look, Iris Energy, I don't want to keep covering this industry, but don't buy this stock in my opinion. It's a tough one it's a tough sell for me. And basically, what does this company do? They own a bunch of Nvidia chips, a bunch of GPUs, and what do they do with the GPUs? Well, still as of 2026 Q3, still 76% of all their revenue is Bitcoin mining. So they're using these GPUs to mine Bitcoin. And then what's the other part of the business? Well, now they're saying, all right, the cloud companies want to rent out their GPUs. So they're like, all right, instead of mining Bitcoin, we'll rent out some of the GPUs to the cloud business. Unfortunately, both businesses are very unprofitable. If we go to the net income, and like it'd be a different story if this company made net income, made free cash flow, had a forward PE, but they don't. I mean, they lost 250 mil this quarter. It was a big miss. They're going to lose 200 mil next quarter, 170 mil of after-tax net income like the next quarters. And look at the free cash flow. Negative 1.3 bill, negative 800 mil. They lose net income, hundreds of millions in net income and hundreds of millions of free cash flow quarter. And it's in a super commoditized, no barrier to entry market. So that's why, unfortunately, I would not, hopefully that made sense. I'm not trying to be bearish. I know a lot of people love these stocks or like Iris Energy and Nebius, but I'm probably losing viewers by giving my honest thoughts, but I mean, I always keep it real. I really would not own that stock. I hate to say it. It could be a fun little short-term swing trade though, day trade or something, but not a buy and never sell stock. Thanks for the insight on Salesforce. Hey, yeah, no problem there, Tom. Yeah, maybe later we'll try and get to ServiceNow. So NK says DFNS. All right, let's see if we can find the stock. T3 Defense. And hey, what's up, Prit? Yeah, we'll look at Micron. I bought Micron at the top. Hey, the memory sector I wouldn't buy meaningfully. Ooh, so dang. This stock is at an all-time low right now because the reverse splits. They used to be 15K a share. But dang, so you want to be cautious. The whole company's worth $49 million. And when a company's worth that little and is at an all-time low like this, it's just hard to trust these kind of stocks. But it looks like some like day traders paradise threw up 73% on the day. But let's see. Can we so basically no analyst cover this company. Let's see the net income right here. So dang. So kind of think about this. This is how I like to approach stocks. And you see where it says they made 100 mil this quarter. They didn't make 3 million this quarter after. They actually lost millions that quarter. But kind of think about this. The whole company's worth 48 million and they lost 26 million just this quarter, or half the company. 10 million the quarter before, 16 million the quarter before, and then 1 mil loss. So I can see why this stock is pretty much at an all-time low. Let's see what the short is. Yeah, there's a reason, 15% of all the shares are being shorted. That doesn't just happen for no reason. There's a real bear case and there's real bankruptcy risk. So that's why I wouldn't own that one. I wouldn't buy shares of it unless you were the day trading. What app are you using? Yeah, hey, Nick NK. Oh, thanks for all the gifts, dude. He left a bunch of gifts. I feel bad. Sorry, all right. Please, Rocket Lab. All right, let's do Rocket Lab stock. Thanks again for those gifts there, NK. If you got another stock you may look at, I'll try and get to them. Oh, I see Helmet Aerospace and Robinhood. Oh, Robinhood next. That's a great one. So here's Rocket Lab right here. This one has phenomenal growth, and they have great contracts with the U.S., with NASA and JAXA. Rocket Lab secures a record 266 million U.S. Space Force contract for up to 18 HASTE subordinable missile defense launches. Rocket Lab signs third multi-launch deal with Japan's IQPS, bringing Electron bookings to 18 missions. Yeah, they have a big backlog. Check out the third line. Backlog increased 20% to 2.22 billion with strong liquidity. And if we just zoom out to the revenue right here, this is what I love to see. And part of this is part of this is inorganic. They did some acquisitions like the Geost acquisition in another company this quarter, but still, it's growth nonetheless. It's very impressive. It hits like a new record pretty much every single quarter. Only slight scary part is they lose 40 to 50 mil a quarter. Same with free cash flow, or a little worse on the free cash flow. So yeah, they lose 50 million a quarter, and but looks like the losses are going to narrow. They're only going to lose 38 million in 2 quarters. So it's good to see them starting to narrow their losses. But that's the only one thing I'd be cautious of, because there is no forward PE, there is no free cash flow on this company, so it's hard to value. There is no I can't compare it to the S&P 500's multiple because they're still probably a couple years away from making any sort of net income or free cash flow, and that's the only scary part. They don't make profits. But that being said, I love the growth on this one. They really do have I looked at a ton of space stocks. This is definitely one of the better ones, but still one I wouldn't own meaningfully. One I really like is actually MDA Space right here. This one actually, unlike them, they actually make net income every quarter. They're making 15, 20 million of after-tax net income a quarter, with revenue up 36% year over year. After grew 58, after grew 20. So nice little growth on MDA Space. That's another maybe alternative. Hey, we literally just looked at Take-Two stock, man. Yeah, that's the GTA 6 stock. What app is this? Yeah, hey, again, I feel bad people keep asking. Yeah, it's a brokerage just like Schwab and E-Trade. If you'd like to get it, it's linked in bio, brokerage. So let's do Robinhood stock. And these are all actually brokerages. I have them linked in my link tree, but if you want to get the affiliate link for any of them, they're all brokerages where they ask for a lot of information. Just where you buy and sell stocks, you pay taxes and stuff. But yeah, I am a user of Robinhood. And I own their stock as well. This is my favorite brokerage. So the one I'm using right now is called Moomoo, the one linked in bio. This is the best brokerage to get, in my opinion, if you're trying to buy and actually analyze stocks as well. It actually has lower fees than Webull. Same no fee commission as Robinhood. But anyway, Robinhood stock right here, I freaking love them because they just disclosed. So whenever you buy and sell a stock on a brokerage, they keep a 0.1% margin. But whenever you do a prediction market, which I never recommend doing because it's pure speculation, your risk to reward is better in stocks. Will the U.S. confirm that aliens exist? Like this, who's behind this? But whenever you do these kind of contracts, they keep a 2% fee. It's literally 20x more valuable for their bottom line than stock buying. And that's why you see every brokerage now pushing prediction markets, because they're so dang profitable. The only thing that's leading Robinhood to fall a bit is crypto transaction revenue. If we go to their crypto trading volume, this is cool KPI data we get. Look at this. So their crypto volume is down like 40% year over year. And that's probably because Bitcoin is down 50% in just 1 year. Can you believe that? Like Bitcoin a year ago was 123, now it's 63K. big little decline on Bitcoin, and Robinhood makes a lot of fees from crypto transactions. But why they're rallying up? If we notice the past couple months, they're rallying up way more than Bitcoin is. It's because of the new prediction market tailwind, and these are money printers. I love the brokerage industry. I own SoFi, I own Robinhood, I own Moomoo, the app I'm using now. They're all publicly traded stocks. And by the way, even if Robinhood or Moomoo or Webull were to go bankrupt, your stocks are SIPC insured for 250K, and your cash on your brokerage is FDIC insured for 250K. So anyway, look at these net margins. None of these are even have a chance of going bankrupt. But look at this. Their net margins are 43%. And they had a slight one-time adjustment last quarter. They actually had a 40% margin. So for every $100 that comes in, Robinhood keeps like $43 after tax. So that's why I say they're basically collecting royalties. Like they did 1.3 bill of revenue. On that revenue, they kept 570 mil. I mean, ridiculous, 43% net margin. They're going to make 450 mil next quarter, 500 mil the quarter after. The only slight bad part is they're a bit expensive, 38 times next year's net income. Might still, that's why I would not buy meaningfully yet. They certainly deserve a high valuation for how quality their financials are. But one, I would actually, Robinhood is one of my biggest regrets ever was selling him. So I'm up 558% on my shares. I only have 5 shares left. Look at this huge L. I sold over 55 shares at $36 a share, and Robinhood's $91. I would have made an insane amount more if only I kept on to my shares. So, and that's actually some of my biggest regrets ever. It's not buying bad stocks. It's actually been selling out of great ones too early. Like Palantir, I sold Palantir at $9. Okay. SK Hynix, SKHY. Yeah, this is basically Korea's Micron. This is Korean SanDisk. They are another memory shortage stock. So yeah, we've converted the currency from KRW to USD. But check this out right here. This is why all the memory stocks, like this isn't some peak bubble valuation. They trade at 19 times net income and 4.7 times next year's net income. It's hard to be bearish at these valuations. See, Morningstar even says they're undervalued. The recent market sell-offs appear to be overdone. It's high market leadership and AI-driven bandwidth memory, along with resilient operating margins, will drive long-term value growth. But yeah, look at these forecasts. Dang, they did 60 billion of net income this quarter. That's insane. So they're going to do 42 bill next quarter, 49 bill the quarter after. So they're selling these, memory chips at a 50 to 70% net margin. The only bear case is like 2028, 2029. That's going to be peak ever net income for them. And that's why I wouldn't permanently hold this stock. It's a great short-term to medium-term stock. Like they'll probably do great through the end of the decade, but you got to think of the super long-term thesis there. That's a little scary. But I feel like on their next 2 earnings report, just like Micron, like for the next 2 years, you're good. You don't have to worry about that, I feel like. But I think the market's starting to realize that, like, all right, they can't sell these commodity at a 70% net margin forever. All right. Especially as the supply chain fixes. Yeah, hey, try not to spam there. All right, we'll try and get to BHF after this. I saw Broadcom and, NextEra Energy, and I'm so behind. I apologize. I see, what's up, Sam? He says Intel and O5 ADI. I appreciate everyone that's here. If you are enjoying, please leave a like. I greatly appreciate that. I feel bad. I really feel bad for all the stocks I can't get to. I really try and get to all of them. That's why I only spend 1 minute each on each stock, so I can try and get to everyone's. So here's Broadcom right here. And hey, Landut, thanks for that little chili pepper there. So here's Broadcom. This is the company that makes the TPUs for Google. Google, I believe, is their biggest customer right now. Is there any other news? Apple signs multi-year agreement with Broadcom, exceeding $30 billion for U.S. supply chain. So yeah, basically, Google's making their own custom TPUs in response to NVIDIA's chips, and Broadcom's actually manufacturing that. And here's why actually Morningstar says they're undervalued too. Its dominant position in custom AI TPUs, massive and pending shipments to hyperscalers, and highly sticky enterprise software will drive long-term value growth. Look at this. It says they trade at 64 times net income. You really want to value them on a forward PE. Look at how this gets cut by more than in half. They only trade at 29 times next year's net income. That's because the net income is literally doubling this year. And a 29 forward PE for the sort of growth that they have is, in my opinion, very fair if not undervalued. Their semiconductor business is their growthiest business. It's up 78% year over year. The growth rate is starting to reaccelerate even faster. It's up 78%. That's the fastest growth rate on the entire screen. And look at these net income forecasts. This is the best news ever. Check out in 2 quarters, they're expected to make $15 billion of net income. If we zoom out, net income has never even been close to 15 billion before. This was a record, a 9.3 billion. It's not done. The net income growth is going to, or net income's growing to 15 billion. That's why you want to value them doing a forward PE or next year's net income and a 29 forward PE. 0.7% dividend yield. They're making OpenAI's new jalapeno chip. They just signed a $30 billion deal with Apple. Samsung and Broadcom signed $200 billion deal for AI chips. It's hard to be bearish. I think their VMware business is struggling a little bit, but their main semiconductor business is I love the TPU business. Hey, thanks, NK. I appreciate that. So, hopefully I didn't just unplug my microphone. Let me double check I just didn't. Okay, good. Here's Analog Devices. Yeah, then we'll get to NextAir Energy and what's up, Plasma? He says STRL. Yeah, Sterling. My bad. For some reason YouTube translated that into a different language and it didn't say. Okay, sorry. So here's Analog Devices. I bet you this is a big beneficiary of the capex spend from the Mag 7. So let's see here. They're at so they trade at 53 times net income, but only a 32 forward PE. So they're having a lot of net income growth about to happen. Yeah, look at these forecasts. This is great. Net income on the left is growing from 787 to 1.37. Revenue's going from 3 billion to 4 billion. Wow, so there is still massive growth on this company as well ahead. And look at that pricing power. Holy schmoly. So the revenue is up 37%, but the net income is up by 106%. What does that mean in English? That's pricing power, margin expansion. Net margin went from a 21% to a 32%. If we zoom out, that's their best margin like ever. So I can see why the stock is pretty much at an all-time high and why they've done so well. It's genuinely the fundamentals increasing, and it has a 1.12% dividend yield here. Interesting there. So yeah, looks like they're also a bit have some international exposure. US is only 30% of the revenue. Then they got China, Europe. Pretty cool, a semiconductor beneficiary right there. So NextAir Energy, this is a regulated utility. It's actually the world's largest utility by market cap. If you live in Florida, you almost certainly are a customer of them. They own Florida Power and Light. And just Florida Power and Light does $4 to 5 billion of revenue a quarter. I mean, it's insane. Yeah, they're also, I believe, trying to get it. They just bought a nuclear reactor. NextAir Energy and Brookfield plan 100 billion AI data center campus in Kentucky. Wonder if anyway, I'm not finding the news around the nuclear reactor. But anyway, this one hasn't done amazing. It's technically the same price that it was in 2021. So it's been flat for 5 years, which has underperformed pretty much every utility, which is unfortunate. So they have a 2.8% dividend yield. The good part is these utilities usually just give you like 7% of your money back a year. Like they really do have a sustainable 2.75% dividend. The regulated utility industry is interesting because if they don't get a guaranteed return on their money, or if they don't get a positive return on their money, the government literally guarantees them a positive return. But on the other end of that, they're not allowed to make more than like an 8% return a year or something like that. But these data centers now have these regulated utilities have the perfect excuse to ask for price increases because of these new data centers. I actually own Southern Company. It's actually, in my opinion, a slight bit better regulated utility play. And what the funny part is, they have a cheaper valuation and a higher dividend yield and better growth, which is funny. But yeah, this one has a 20 forward PE and a 3.2% dividend yield. In full disclosure, I do own that one. Yeah, I got 11 shares of this one. Yeah, pretty cool stock here. They own Georgia Power and Light, Alabama Power and Light. They're specifically in like the southeast. All right. Yeah, Reddit's up 9% today. Really? Let me see actually, because I do own them. Yeah, check that out. Reddit's up 8.2. I love that stock. It's a lot of people think it's a meme stock, but if you look at their financials, they're so impressive. Microsoft's up 5%. Yeah, specifically the mega caps are doing great. Look at that. Meta's up 6, Google's up 5, Microsoft 5, Amazon 5. CEG 4, Nvidia's up 3. So, yeah. Can you give me every app you use for investing? Yeah, hey, these are all brokerages. They're like Schwab, E-Trade. They all ask for a bunch of information. It's where you buy and sell stocks on. They're all on my YouTube channel. I have like a video where I compare all 3 of the brokerages, but this is by far my favorite one with the lowest fees. If you want to get this brokerage I'm on, it's the best one for stock analysis as well, where you can analyze stocks on top of buying them, and you get a free 3.35% APY on your idle cash. It's actually linked in bio there. It's a brokerage called Moomoo. You can just type it into Google, but if you want to use my affiliate link, it's linked in bio, completely free. You don't have to deposit any money to use the analysis tools. Like someone said PGY stock, you can still see all this all these financial metrics without even having to deposit anything. Anyway, PGY just had stellar earnings. They're up 13% of the day. I'll give a quick glance at this one. Analyst forecasted 31 million net income. They did 45 million in net income. So it's no surprise the stock is up 13%. When you beat that massively, you know, your stock's almost certainly going to go up. And that was a real beat. It wasn't like some one-time adjustment. Even on EBIT, earnings before interest taxes, they expected 82. They did 105. Let me see if I can remember what they do again. Let's go to their website right here. So they say approve more loans and retain more customers with the Pagaya network, all with no additional credit risk. Oh yeah, it's like that fintech overseas, like, I don't know, integrate your loan origination system through them. Anyway, so you keep more borrowers, grow without risk, build loyalty. So anyway, it's helping out fintech stocks. I know SoFi is a customer, like US Bank Corp's a customer of this one. Yeah, that's great net income growth that they have. So interesting there. I wish I could give you better thoughts on this one, but look at this. This is why they're probably just going to continue to climb higher. If we look at the valuation, even after its 13% rally, they only trade at a 9.2 forward PE or 9 times next year's net income. How do you feel after an insane Amazon week? Yo, I feel great, and I'm feeling like I'm not going to trim any shares of anything. You know, actually, specifically, this is called my buy and never sell portfolio, where once I buy a stock in here, I'm literally never allowed to sell it, even if I wanted to. So yeah, like I won't even trim a single share. So yeah, Amazon, even if I didn't have that rule where I'm not allowed to sell, I would not be selling this one. They deserve to be at this price, and they're still honestly like the valuation isn't fully maxed out yet. Oh yeah, oh my goodness, Plasma, I'm so behind here. STRL. I'm like, oh, hey, CTIS, dude, thanks for the nice words. Yeah, if you're enjoying the stream, I try and stream every day. If you want to hit the follow button, I sell nothing. I have no course book. There's no way. Someone's been asking, like, how do I learn more from you? Literally just by watching the streams for free. I sell nothing. I don't coach. I have no course or book or anything. Yeah, watch out for people impersonating me. I'll never follow you, DM you. Just had to ban someone with the same name as profile pictures me. Oh, okay, BHF will do after this. All right, sorry. I know. I apologize. All right, ABH, I got you. BHF stock is next. And what's this app again? Yeah, people keep asking. I'm on a brokerage right here. It's linked in bio if you want to get it. So here's Sterling Infrastructure. They do the complex MEP work for your data centers and or they specifically cater for data centers and the construction and the MEP work of data centers. So if we go to that business right here, their main infrastructure solutions, check out that growth rate. It is up 173% year over year. That's the fastest it has ever grown to a record by far. When we combine all their businesses and we look at revenue, yeah, look at that. So by far, this was their best ever quarter in history, 91% revenue growth, and the net income grew 143%. So the margins actually expanded there. Net margin went from a 9.8 to a 12.5. So insane. They did 100 mil in net income this quarter. Let's see. So engineering and construction is their industry. Maybe we can check out their website right here. Maybe understand, maybe see some of the projects that they've worked on. So we build and service the infrastructure that enables our people to run. So yeah, anyway, I wonder, I'd love to look at their investor presentation. I just don't want to spend crazy long on one stock right here, but we should look at their investor presentation sometime. Yeah, look at that forward PE. A 33 forward PE, not bad compared to the 55 trailing 12 months PE. I can see why they've done so well. And they're on a bit of a, healthy RSI retrace, like all AI stocks, like Comfort Systems, like Powell Industries is, I think, a competitor. I don't know, though. They're all also in kind of a little dip right now. So what was that stock that guy said? BHF. Let's see, BHF stock. So Bright House Financial. Cool, we found it. Looks like someone tried to acquire them back here, and then the deal didn't go through. Whenever you see a stock look like this, that means they were trying to get bought out, and then it slowly went down because the odds of them being bought out went down, and now it looks like, I don't know, guess they're not being bought out anymore. But let's see what their financials are. How are they doing? So annuities, runoff, and life insurance, maybe? Is that what they do? So yeah, they're a life insurance company. Huh. Okay. Let's see what the revenue growth is. So it's a little choppy. If we go to the revenue, the lifeblood of the company, it's down 36%. Well, actually, we should annualize this. That would be the better view. So yeah, okay. Well, even when we do the full year, technically the full year 2025 revenue is lower than like a lot of other years. Like it was lower than their 2014 and 2015. So if we zoom out, so actually, yeah, this stock is technically the same price that it was in 2016. And I bet it's the same price that it was in 2016 because the profits and let's see, net income. Yeah, the net income is kind of choppy. So nothing's really blowing me away here. And if you like insurance, I have a new stock that I've guaranteed you've never heard of before, unless you've heard my previous pitch on it. But this is Slide Insurance. I'll be quick about this one. They just actually, for the first time ever, just started paying a dividend because they're so profitable. But this is specifically coastal insurance in Florida. So they literally do, hurricane insurance for Florida, South Carolina, California, and they're getting into New York and New Jersey. And if you live in Florida, you know the insurance costs are ridiculous. And check out how profitable it is for them. Like we all hate the insurance companies. This is why. Look at their net margins. For every $100 that comes in, they're keeping $40. Like if you average out the net margin, they're keeping $40 after tax. So like look at this revenue growth. Record revenue. Revenue's up 47. So 386 mil of revenue, and on that they kept 134 mil after tax, and the margin expanded. Their net margin went from a 26 to a 35. So yeah, that's your hurricane insurance business. There you go. Affirm. Okay, O5 said Affirm. This is your buy now, pay later company. W Reddit, yes, sir. Thoughts on Toast? Did they just become profitable? They've been profitable, actually. Toast is a nice little point of sale restaurant company. Oracle is up. Yeah, hey, I think it's because all the cloud stocks are up today. SpaceX earnings, short. Hey, I'm not a big fan of SpaceX simply because they're really overvalued, sadly, even on the dips. So maybe we'll cover SpaceX, but I wonder when their earnings are. Are they actually like today or this week? So here's Affirm Holdings. This is your buy now, pay later company. I think they've partnered with Amazon. So anything you get on Amazon, you can buy now, pay later it, which I don't recommend doing. But they're finally insanely profitable. Like for all of history, this was a tough sell. They're losing like 100, 200 mil a quarter. But check this out now. They're now making over 100 million in net income a quarter, and it's forecasted to continue to grow. They're going to make 119 mil next quarter, 122 mil the quarter after. And notice they're beating on expectations. So that's actually why this one's not too shabby. They're at a 44 forward PE though, so they trade at 45 times next year's net income. But whenever you're growing net income, triple digits, quadruple digits this quarter, matter of fact, whenever you're growing net income so quickly, it's usually normal for them to have a really high forward PE like that. You really want to do like a PEG ratio, a multiple year out, like EPS CAGR. So Morningstar actually does say they're a bit overvalued. Although the company benefits from strong transaction volume and an expanding merchant network, its heavy reliance on external capital markets for funding and elevated exposure risk to economic cycles require caution. So basically what they're saying is in a recession, if we get like in a real recession, these loans just won't get paid back. I mean, like that's the last loan that's going to get paid off. The buy now, pay later for your Walmart orders, whatever. Some of these loans just won't get paid back, and so what they're doing is they're actually selling some of the loans now. It's an interesting company. Someone said Berkshire Hathaway. Yo, yeah, this is a great S&P 500 alternative. Historically, they keep up and I think outperform the S&P 500. So this is a great way to diversify yourself. Instead of just owning one company individually, you own so many great stocks. Like, oh yeah, they literally own Geico, they own Pilot, the gas station, they own BNSF Railroad, and then their portfolio is so big that they literally individually own a bunch of stocks. They own Apple, American Express, Coca-Cola, Bank of America, Google, Chevron. So they own shares in publicly traded stocks. Hey, what's up, MC? Yes, sir, we get Powell Industries earnings. I'm super excited in like 3 hours, 4 hours. Wish me luck. It's 10% of my portfolio. So Japan actually, you should look at the Apple dip and AXP. You know what? Let's look at Apple and then American Express, or if I remember, and we'll try and get to Toast. And oh yeah, hey, Grab. I actually do like Grab. That's international Uber. Remind me, we'll get to that one too. So here's Apple stock. They fell on earnings. I wonder if there was a specific reason. Issues weak guidance as CEO Tim Cook prepares to step down. Memory chip shortage causes MacBook Air supply delays and price increases across Apple's lineup. Here's kind of a cool little thesis I have. So all these companies like Xbox, PS5, Nintendo Switches, they're raising prices because of the memory shortage. But I bet you whenever the memory shortage is over, they're going to keep prices elevated. They're not going to lower prices at the same rate that the commodity falls. And I think that's bullish news. The 33 forward PE might still be a bit expensive. So dang, Let's see though. I mean, here's why Apple, this is a great never sell stock though. They they sell you the hardware, they sell you the iPhone, but then their most profitable business is actually the App Store transaction fees. Every time you spend $100 or any amount of money in the App Store, They keep $30. They keep 30% of every transaction in the App Store as a royalty. It literally costs nothing just to take a fee from that App Store. So yeah, they also got Mac sales, iPad, and the smartwatches as well. And they're a money printer. If we zoom out, I mean, they're always making like 20, 30, 40 billion in net income a quarter. So I mean, it's tough to be bearish. I mean, they really are a money printer. But what does Morningstar say? So Morningstar does say they're overvalued. While the company enjoys immense demand for its premium ecosystem, yeah, a lot of people are locked in the Apple ecosystem. They got the AirPods, the iPhone, the Macs, but short-term supply constraints, rising memory cost inflation, and heavy reliance on cyclical consumer spending require caution. It's like the new iPhone upgrade cycle is like not happening as fast as they want. But still, this company has the largest share buyback program of any company on earth. This is ridiculous. And they're actually being rewarded for not spending so much on CapEx. But look at their buybacks. They buy back every quarter, no matter what, for all of history. If we zoom out to 2021 even, there's 2023, here's 2022. Notice they literally spend $20 billion or more a quarter solely buying back their own stock. Or like they buy back basically 4 to 5% of the shares a year. Like they bought back 5% of the company down here, another 5% here, another 5% here, another 5% here. They buy back 5% of the company a year. That's why the stock never goes down. So yeah, they're really impressive. Um, I just don't. I don't know if I'd buy meaningfully yet. I'd probably wait a little longer to buy meaningfully. But you get a nice. It's a great dividend growth stock. Like Google's actually really cheap compared to Apple. So, and Google has the Google phones. I just bought the new Google Fitbit. Did you know Google only trades at a 27 times next year's net income? Apple's at a 33. Meta's at an 18. I mean, there's some really cheap stocks out there. Okay, and then the other stock. Okay, let's do Grab, and then we'll get to American Express, another Buffett holding. So I'll be quick about this one. When I signed up for this, bro, someone just asked what app is this. Hey, if you sign up for this app with my link, we both get some like free stocks. When I signed up for the app, I got a free share of Grab and Forward, and I sold it instantly. If you want to get this brokerage I'm on, yeah, it's linked in bio there. It's an affiliate link. If you deposit $100, we both get like some free stocks. But anyway, here's Grab. Here's what they do. I basically call them international Uber. They do exactly what Uber does: ride sharing and delivery. But notice the US and Canada aren't on here. Here's where the revenue comes from: Malaysia, Singapore, Indonesia, Philippines, Thailand, Vietnam. It's all these more international markets, which, this is a universally needed commodity, or like convenience, and they're finally profitable. Look at these net income growth rates year over year. Easy comparing from small numbers, but yeah, they used to lose a lot of money. Now this company's going to be making money for the rest of time. And my favorite part about this company is the fact that Uber is backing them. Uber loves them so much, and Uber's having a tough time getting into those markets. So they're like, you know what? Let's just buy the top player. So Uber owns 13% of all the company. So there's no company to benefit more than Uber to see Grab succeed. Toyota Motor owns 5.5% of the share. So yeah, I call it international Uber, but the valuation still might be a little, what is it? Yeah, 47 forward PE, but that's because they're just now getting net income positive. I really wouldn't worry about that because they're going to grow triple digit net income. Also, you have to worry, I don't know what those other countries, but the robo-taxi, autonomous vehicle, what will that do to them? All right, so next up, oh yeah, American Express. Back to Buffett's portfolio right here. Then we'll try and get to, you mess with meme coins? No. Can we do Futu? Yeah, I'll try and get to Mumu app as well. Yeah, and Palantir. Oh, I see Palantir AXDI. Again, hey, General Black, good to see you, man. Thanks for being a member. John, too. I am warming up to SpaceX every time it drops. How do you like Teradyne for testing in robotics? Actually, Teradyne's a really underrated robotics play. Say the ticker in the chat, and then I'll check that one out as well. So back to Warren Buffett's portfolio. As we know, his largest holding is Apple. His second largest holding, if you didn't know, is American Express. It's 15% of his portfolio. And this is another really impressive company when we start to look at their financials. And honestly, even after this huge rally that they've had the past 5 years, they still aren't expensive. Even after this huge rally, they traded an 18 times net income. The S&P 500 trades at a 27 PE ratio, so they're significantly cheaper than the S&P 500, and they basically collect, well, not as high royalty or margins as Visa, but check out that revenue growth. Like the revenue slowly just hits a new record every quarter, and they print money, easily making like $3 billion of after-tax net income every quarter. And it's grown over time. Yeah, impressive. So yeah, it's just a nice dividend growth stock. You buy them right now. You get over 1% of your money back, and look at that dividend growth every year, raising their dividend faster than inflation. So it's an impressive one, and it's at a reasonable valuation. Morningstar says they're reasonably valued, a highly affluent cardholder base, robust momentum in premium card acquisitions, and resilient discount revenue growth will continue to drive long-term value growth despite some near-term headwinds from elevated reward expenses. Any other news around them? EPS guidance maintained. Cool. Anyway, that's AXP, American Express. All right. So, oh geez, man, I am just like, so is AXTI, is that the mineral company? Yeah, I think this is the raw substrate supplier. Yeah, so actually, I'll be quick about this one. One I'd still be cautious with, but they had a huge beat on earnings. Basically, these chips, like these UAV machines that make the chips and stuff, use these specific metals like indium phosphide and gallium arsenide. And these precious metals are specifically used in data center components. And they just had stellar beat on earnings. They're finally net income positive. If we zoom out for all of history, they've never made net income, but now they're finally going to be consistently net income positive now. The analyst forecasted 3 mil of profits. They did 11 million, and that's real. Even on the earnings before interest taxes, they expected 1 million. They did 10 million. That's a beat by 900%. And they're going to make 19 mil next quarter and 23 mil the quarter after. And that's on some good margins. Like they're going to do 66 mil of revenue next quarter, and they're keeping 19 mil of that. So they're really going to have like a 30% net margin. It's actually really impressive. So because they're just now getting net income positive, they're at a high forward PE of a 42. But honestly, it's super interesting. Some rare earth metal play for data centers. And honestly, if they beat on net income like crazy this quarter, they will in the future. What site is this? Yeah, hey, this is a brokerage. Yeah, hey, thanks for that. Yeah, this brokerage is linked in bio. Brokerage called Moomoo. It's just like Schwab. Let's do, Teradyne, TER. All right, TER. Oh, that's the ticker symbol. Okay. And then we'll do Futu and Palantir, Novartis, AEHR. I'm so behind. Uber stepped down from Grab's board. Hey, that's actually not a bad thing. So anyway, here's Teradyne right here. Actually, their robotics division is super impressive, and they do semiconductor testing. Huh. But look at how they've beaten on expectations. So no wonder this stock has done so well. Like especially the past year, the stock went from $65 to 360. Almost certainly because it's not just momentum, it's the real fundamentals beating on expectations. Like check it out, the past 3 quarters in a row, they've had massive beats on net income. They expected 293 and pulled off 374, and a triple beat on revenue the past 3 quarters in a row. So margin expansion, net margin went from a 12 to a 28. So for every $100 that comes in, they keep $28 after tax. So really impressive stuff here. And the forecasts are good as well. And, most likely they're going to beat on the forecast like they did. Have you always had a face cam? No, I just recently started doing the face cam. TikTok's been giving me issues. TikTok they used to take down my stream for unoriginality. And I'm like, they were telling me to use a face cam. So I'm like, all right, fine. But the no face cam stream is on YouTube. Actually, that's the only way to support me if you'd like to. I sell nothing. If you type into YouTube Nathan Robert, you'll find my stream on YouTube, and you can rewind, replay it. I'm trying to build up my YouTube channel. TikTok yesterday they actually took down my stream as well. So the YouTube stream never gets taken down. If that's the only way to support me, it actually mean more than a donation to just check out my YouTube, and you can watch the stream from there. So next up, Palantir, I said, yeah, Palantir. And then we'll try and get to the next stocks here. What is your top buy currently? That's a great question. I honestly don't know because a lot of the stuff I have been recommending, like Microsoft and Amazon and Meta, they all just went crazy rally today. But I will show you my most recent stock purchase, and that is Citigroup, ticker symbol C. I just bought them for the first time ever. A nice little fintech bank stock. And check out I'm not even scared to buy this. They've had a crazy rally. I'm not scared to buy them even after this rally. They have an over 2% dividend. You buy shares today, you're getting over 2% of your money back in a dividend. 11.7 forward PE, only 11 times next year's net income. They've bought back 11% of the stock this past year. So you own 11% more of the company on top of getting a 2% dividend and a low PE ratio. And they just announced they're going to buy back another 15% of the company. They said a 35 billion buyback. The whole company is worth 220 billion. So that's over 15% of all the shares. Pretty nuts. But here are all my most recent purchases in their exact order. Oh, actually, 2 days ago I bought more SoFi stock, and they're up since my SoFi buy. They're up like 15%. So it's a lot of stocks I want to recommend. It's tougher to recommend now after their rally. But yeah, if you want to stay updated, check out my YouTube channel. I do YouTube videos all the time on updates on what I think are good buys and on the live streams too. So here's Palantir. Back to the analysis here. I would love to own this stock. And y'all put the L's in the chat here. Look at this. I used to own Palantir. Right now, or look at this. I sold my Palantir at $8.29, and Palantir is $125. Biggest L ever. My biggest regrets are actually selling out of great companies like Palantir. I'm going to get back into this stock eventually, but here's what's so impressive about them. Half of the revenue comes from the government, the Pentagon, the Air Force, like every police station uses Palantir. And that government business is up 76% year over year. After grew 45, after grew 16, after grew 19. Like they're on a streak of growth. And notice the growth rate this quarter of 76% is the fastest it's been in literally ever. And this is the fastest growth rate in 5 years. 76% growth year over year, not just the government side, but also the commercial side with companies like Google and GE Aerospace. That doubled. It's up 95% after grew 32, after grew 26. It's also the fastest growth rate in years. So I'm obsessed with this stock, and check out these profits and how they're beating on expectations. The orange lines was the net income forecast. The blue lines what they actually report. In the past 3 quarters in a row, they crush on earnings. They now have over a 50% net margin. So they're practically collecting royalties every time you spend $100 with them. They keep $53 after tax, and that's pricing power. This margin expansion went from a 24 to a 53. Like imagine Coca-Cola if they could grow their margin by 1%, selling 10 million bottles, or it's crazy. The pricing power. Is there any other news here? Initiates coverage with outperform rating on Palantir, a $200 price target. Yeah, dude, it's a $125 stock today. So the revenue grew. Oh, and another thing that takes a ton of risk off the table is they literally have no debt. They're completely debt-free with over $8 billion of cash. Whenever they make net income and free cash flow, since they have no debt and don't owe anyone any money, just go straight to the cash pile. So look at that net income growth. Anyway, I have no complaints around this stock. Check out that growth over time. Except the valuation's still a slight bit expensive, but they deserve to be expensive. They have like the DNA of a multi-bagger: no debt, pricing power, margin expansion, revenue, net income growth. 82 forward PE still is a slight bit expensive for me to buy meaningfully. All right. Oh shoot, same bro. I sold Palantir too early. Yeah. That's why I actually made this portfolio right here. It's called my buy and never sell portfolio. Once I buy a stock in here, it's an experiment. I'm never allowed to sell it. So I'll never be able to make that mistake again with these great companies. Another huge L was like Robinhood I sold. I sold my 55 shares of Robinhood at 36 a share, and Robinhood's $91 a share now. So, they say don't trim your flowers and plant weeds. Or like don't sell your winners and then buy junkier companies. All right. Sometimes what I like to do is upgrade a position where if I'm up a bunch on a stock and I see a better risk to reward somewhere, a stock with better financials, a stock that I think will give me a better total return a year, I'll call it upgrade the position. So, geez, I'm behind. Hey, what's up, Isaiah? And Emaz. Let's see your portfolio. Yeah, hey, I just did a huge stock portfolio update. I do it at the beginning and end of every stream. So AEHR, this is Air Test Systems. Wow, actually, I've never heard of this stock, and they've done very well. Let's see if we can figure out why. So they do systems, contractors, and services. So it looks like Asia stock, or half the revenue comes from Asia. Where are they headquartered? They're headquartered in California. Okay, so it's a U.S. listed company, 138 employees. Just looks like half the revenue's from Asia, 41% is the United States. But wow, actually the forecasts are really good. If we zoom out on the revenue, well, I guess that doesn't look too great. They did 18 million in revenue this quarter. Look what analysts forecast. They expect it to be 36 million in 2 quarters. And also, they're expected to make 4 million of net income on that. They're going to have over a 10% net margin. If we zoom out, hey, they made net income this quarter. So it looks like the fundamentals are really just like if I own the stock, I would really hold on to it for the next 2 years. I mean, or 2 quarters, at the very least. Yeah. All metrics are forecasted to just explode higher. So I wonder, so they're in the semiconductor equipment industry. Manufacture, market, and sale of test and burn and equipment used in semiconductor industry. So some sort of you know, data center beneficiary. I mean, I'm trying to load their website right here. I don't know if their website will work. Please? Oh, here we go. So they do wafer and package parts. So look, all these components are kind of the stuff that's being a huge benefit from data centers right now. So anyway, so record quarterly bookings and $100 million backlog. So they have over $100 million backlog. You get these forecasts are good. Anyway, hopefully that was kind of helpful there. Still want to be a little cautious with. Hood is my number one stock. Yo, hey, nice. I love Robinhood. Me too. I own Robinhood stock as well. So, Isaiah said Zoetis. Yeah, this is the animal healthcare company. They specifically do animal healthcare products. Like every time you look at a cow and you see like a white circle in its ear, that spreads like a bunch of anti like what's it like parasiticide stuff where it keeps parasites off of them. It spreads throughout their whole body from their ear. They make stuff like that, and all this is for animals. So they do parasiticides, they do vaccines, dermatology, pain and sedation, anti-infectants, and other pharmaceuticals. The recent reason they've fallen is because of lower guidance and slow revenue growth. This is the one thing I'd be cautious of. Like this is why they're not beating the S&P 500 because they're not growing like the S&P. Like if we look at the revenue, the sales, the lifeblood of the company, it only grew 2.9% this quarter, 3% last quarter, 0.5, 4, 0.3. This is low single digits. It just barely beats inflation and maybe even doesn't beat inflation. And their margins actually fell a little too. So like the revenue increased by 3%, but the net income fell by 0.1. That means their net margin did fall a little bit. So I can see why they did just have this big gap down. But honestly, I think the worst fears are fully priced in at this 11 forward PE. Yeah, they're literally trading like a commodity stock. Where's my cup? There's my cup. Okay. So yeah, maybe the fears are fully priced in. 11.7 forward PE. Okay, Morningstar does cover this one. I like looking at this. He says, here's what the bulls are saying, and these are what the bears are saying. Here's, I guess, what the bears are saying. Strict regulation and restriction for antibiotic use in animals could harm zoonotic sales, but growing interest in probiotics, antibacterial peptides, and immune modulators as an alternative to antibiotics offer many growth innovations. Companion animals are increasingly viewed as family members, drastic increasing owners' willingness to spend on pet health. They had their own study where, oh gosh, I'm going to fumble it now. Like if like they would I really forgot it, but it's like if someone had like was down to their last $1,000, they'd rather spend it on their pet than like food or something. I really forget what it was. But yeah, they do really see like pets as part of the family. All right. Okay, let's do food too. So this app I am on right now, this brokerage I'm literally using right now, is publicly traded, and here's their stock right there. And this app has 30 million users, up from 26 million same time last year. What I love about this stock is they collect most of their income from interest income. So look at this. That grew 27%, after grew 53, after grew 5. Here's the cool selling point for Moomoo, this brokerage I'm on. Right now, they give you literally for free. It's like better than a high yield savings account because it's liquid. If you deposit your cash, they give you for free a 3.35% APY on your idle cash as it just sits there. You can spend it at any time or withdraw it at any time. And they earn like a 3.8% APY on it. They just pocket the difference. It's extremely high margin for them. And also, this brokerage, Moomoo, just introduced prediction markets into the app and crypto trading. And that I think is going to be extremely profitable, just like it was for Robinhood. The recently they've fallen is because they just had a one-time fee, so they allowed people in mainland China to buy US ADR stocks. I know, like big deal, right? But they allowed people in China to buy US stocks, which wasn't allowed. So China fined Futu and they fined TIGR, another brokerage as well, international brokerage. But their US brokerage business is like the best ever. They're at a 9.4 forward PE. And so, yeah, this net income quarter included that one-time adjustment because historically they're always making a 400 mil plus a net income a quarter with 50% plus net margins. So pretty insane. And same with Robinhood as well. So I own Futu and I own Robinhood stock. And by the way, if you want to get this brokerage I'm using, Moomoo, the stock we just analyzed, you actually would use the platform. I have it linked in bio if you want to use this app I'm on. It's my favorite one. Actually, I like it more than Webull and Robinhood. These are all brokerages as well. I own Robinhood stock as well. I love the whole brokerage industry because Robinhood just disclosed whenever you buy and sell a stock, Robinhood keeps a 0.1% fee on it. But whenever you buy and sell a prediction market contract, they keep a 2% fee. It's literally 20x more valuable for their bottom line. And that's why you see every fintech app adding prediction markets because it's so freaking profitable. And by the way, I never really recommend doing prediction markets. Your risk reward is better in stocks, but like stuff like, will the US confirm that aliens exist before January 2026, 22% chance? Like, I don't do those. You'd rather buy stocks. So, yeah. Oh, and Webull as well. This brokerage just added in prediction markets as well. It says new. They just added in prediction markets. So everyone's trying to get in. I think Coinbase just announced as well they're getting into it. But yeah, Moomoo, they really do have the best brokerage. And I like their stock too. And I own their stock as well. Full disclosure, here's my position. I'm actually down on them. Yeah, I'm down 13%. You can get in at a cheaper cost basis than me. Okay, fair value for Hood would be a slight bit lower than where it is right now. So I kind of would not buy Robinhood right now. So we just looked at Futu. They had 40% net margins. So does Robinhood. They're basically collecting royalties every time you buy an option or do a prediction market. They just collect a high margin commission. So they have 40% plus net margins every quarter. We use Zoetis' heartworm, flea, and tick medication for our dog. Zoetis gets about $25 a month from me. Oh, hey, speaking of Zoetis, that's really cool. Hey, what's up? Long time no see. Hey, Nicolo, dude, good to see you. Hope you're having a great day. Yeah, it's good to see you. I will only sell my winners when they're called away or if it becomes too big of a position in my portfolio. Yeah, I agree. I'm not just going to sell a stock just because it went up a bunch. Like I want to have some real thesis on. All right, we got so many stocks I got to get to. I apologize. Yeah, hey, we just looked at Palantir stock. If you like, go on the YouTube stream and rewind a little bit, you'll find it. On Arista Networks, I'll be quick about this one because this one is impressive. Another data center equipment beneficiary, and this one is at an all-time high for a reason. It's not just momentum; it's the genuine fundamentals improving. Like, you won't believe this. This is so impressive. If we zoom out on the revenue over time, record revenue this quarter. I mean, that's ridiculous. Revenue grew, what was the growth rate? 35% year over year. That's actually the fastest growth rate in like 20 quarters. Revenue's up 35% and the net income is up 25. If we zoom out on the net income, it's also the most, like, we don't just want to see a company growing their revenue. We want to see them also be profitable and growing their net income as well. They're absolutely doing that. They just did $1 billion of net income for the first time ever. They did $1 billion in net income on 2.7 billion of revenue. So they have a crazy net margin. Yeah, 37% net margin. And look at the FCF, which stands for free cash flow. So they just had record revenue, record net income, and record free cash flow this quarter. And at these growth rates, what's it going to be the same time next year? So that's the interesting part. Really good balance sheet as well. Is there any news around Arista Networks? Analyst forecast 28% revenue growth. Huh. Very interesting there. So they're in the computer hardware AI ecosystem. Ethernet. Gosh, I got some allergies right now. Okay, what's next here? What's up, Tired? He says COTY. Let's check that one out. Cody. A $2.5 billion company. They're at basically an all-time low. So dang, I feel bad if you own this one. Let's see what they do though. So they do prestige and consumer beauty. Huh. How is that business growing? So that might be, I think I might have found why the stock is at an all-time low. If we go to the revenue, the lifeblood of the company, it's a little scary. It's actually negative year over year. We want to buy companies that are growing their top and bottom line. The revenue is down 1.3% year over year after it fell 6%. So they're in negative growth territory. Ooh, and they're not making any money. So when you average out the 4 quarters, that looks very choppy. Like, it used to be kind of consistent. They used to make net income pretty much every quarter. Now it's like they make money one quarter and lose money the other 3. So honestly, I can now understand why this stock is kind of at this all-time low level. The fundamentals are deteriorating. So household and beauty products. Maybe we can go to their website right here and see what they sell. Reject all cookies. You do not get my cookies. So okay, what do they sell? Transition of Gucci beauty license, fragrance market. I'm trying to find what you sell, guys. Our brands, okay? Okay, so yeah, stuff like lotions and See all brands. I want to see if I is that what is that Adidas? Is that I don't know what this is. Anyway, let's get to the next stock. I think interesting. I actually, if I like the beauty and cosmetics industry, I would go with Ulta Beauty. Honestly, this is my favorite one. And if we zoom out on their net income, like check out how consistently profitable they are. The other company was like making money one quarter and losing money all the other quarters. This one just consistently makes 300 mil in net income a quarter. Net income grew 11%, but the net income per share grew by 15% because they buy back like 4% of the company a year. And they're also on a dip. So if you're looking for stock on a dip as well, they're also on a dip. It's like out of all the beauty and cosmetic stocks to buy on a dip, I'd go with the most high quality one with the best fundamentals with growth. What is FCF? That is free cash flow. So next up, what is on my buy list? Yeah, nice. Are you ready for CEG earnings? Oh, when is CEG earnings? So August 6th. Okay. That's actually really impressive. So Constellation Energy, I do own this company. I am excited for their earnings. I've looked at every utility and nuclear stock that exist out there. And out of all the ones that exist, this is by far the best one. If you didn't know, they literally own over 30% of all the US's active nuclear reactors. It's the purest play for nuclear energy. There is no close second. This one's literally the best. They do buybacks, dividends, acquisitions. They just did an acquisition that's accretive to EPS and free cash flow. So full disclosure, I do own that one, but I own them for a reason because they're the best. And they're only at a 23 forward PE. And at that valuation, I feel like that can just stretch higher. Uh-oh. Okay. Um, what's next here? Fire Lives has always been busy. Hope you are enjoying a good day. Hey, you too, man. I appreciate the nice words there, Nicolo. Um, Ooh, hey, we kind of just looked at Sterling Infrastructure. Um, can you recommend can you recommend an ETF? I'm not sure what you mean there, but the best ETF is honestly like the QQQ or the Nasdaq 100, which is QQQM. Or this is the best way to get exposure to the Nasdaq 100. It's basically a more tech-heavy version of the S&P 500. Just gives you 10% of your money back a year. Like the goal isn't to get rich quick; it's to slowly build and preserve wealth. Get that 10% a year plus a dividend, and as you reinvest all the profits and dividends, it just compounds like a snowball. And I love all their top holdings. It's market cap weighted, like Apple, then Nvidia, Microsoft, Micron, Amazon, AMD, Google, Broadcom, Meta. All stocks I happily would own, and I do own a lot of those. Like I own Amazon, Microsoft, Google, Meta. ADPT, what's up, Vagabond? Let's do ADPT, then we'll do Google stock. Yeah, hey, what's up, Riaz? Yeah, Google. That's a great one. And then I see Coca-Cola Consolidated. And hey, what's up, Glow? Hey, we'll do FAC. Yeah, thanks for that gift earlier. And Dave Man as well. Yeah, FAC we'll do next. So here's Adaptive Biotechnologies. So this one's on my watch list right here. Let's see what the financials are. So, oh wow, big beat on earnings, but a miss on net income. Huh. So they expected 65 mil of revenue. They did 71 mil. I'm assuming this was a one-time adjustment though, because the EBIT wasn't as bad. Yeah, so they actually narrowed losses by 37%, but there was a little. Did they do an acquisition? Huh, because their assets kind of like bumped up this quarter. Anyway, I love the revenue growth. Revenue's up 21 after it grew 51, but I would still be cautious and I wouldn't buy meaningfully simply because they're still losing net income and are expected to. But look at they're supposed to narrow their losses to only 10 million. Do you own CEG outright? Yeah, I do own CEG. I just showed my position. I got 15 shares of CEG. I am biased. Yeah, I am up 30% on my shares. Yeah, ADPT, interesting. They do minimal residual disease. Huh. I wish I could give you better thoughts on that stock. I apologize. But let's do Google. Yeah, they just reported phenomenal earnings. So Google has the Google Cloud business, and they announced it has a $515 billion backlog of orders that they haven't fulfilled yet. That's why these companies are spending crazy CapEx numbers. The only bad part was, and it's not even bad news to me, is they spent $82 billion on CapEx. That's like the size of most of my company's market cap. That's bigger than Comfort Systems. They spent just in one quarter in CapEx, but it's to fulfill this backlog. And they own YouTube, they own Google Search, which they bought YouTube for $1 billion. Now that is worth a couple $100 billion individually. One of the best investments. And they're also a huge AI player now. With Gemini, I freaking love Gemini. It's my favorite model. Google DeepMind launches Gemini for robotics. Huh. Waymo plan. Oh yeah, Waymo. It's that autonomous driving vehicle company. Google's selling their own TPUs. Google has their own quantum chips, their own cloud. So yeah, anyway, I love the stock, and this isn't some like peak bubble valuation. Even though the stock just had a crazy rally, did you know Google only trades at a 27 times forward PE or 27 times next year's net income? That is fair. That's not some crazy peak bubble valuation to me. And you get a dividend. So, oh yeah, here's the Google Cloud business specifically. So it's now 20% of all their revenue. Google Cloud grew 81% year over year. After grew 31, after grew 30, after grew 22. So they're on a streak of growth. I can see, yeah, they're up 5% of the day. And there was just this article that came out that I actually just literally made a whole YouTube video kind of dedicated to this Morgan Stanley piece. It's my most recent YouTube video. I made it yesterday. If you want to check it out, that'd be the best way to support me more than a donation or something. Check out my most recent YouTube video. My YouTube channel is called Nathan Robert. If you type it into YouTube, you'll find it. But these Morgan Stanley projects a 25 to 50% ROIC on AI infrastructure investments. So companies like Google could yield this capex at 20 to 25 to 50% using GPU leasing, which is a 31% ROIC, proprietary model API service, so making their own LLMs, and third-party infrastructure models, so 25% ROIC. So the capex, like that's part of their moat. No other company can spend like them. And these companies are smart. They're not going to spend money. The market is fearing they're spending money. They're not going to spend it if they knew they wouldn't get a good return. So Rev says Coca-Cola Consolidated. This is actually the largest bottler for Coca-Cola. So it's not the main mothership company. This company simply bottles. Like Coca-Cola sells them the syrup and then they bottle it. This is actually a fascinating company. They bought the permanent affiliate rights back in like 1977 for $1. They bought the permanent affiliate rights in certain states from Coca-Cola. So literally no other bottler, not even the Coca-Cola company themselves, are allowed to sell any Coca-Cola products in certain states like North Carolina. Can we find the map, please? Usually the map loads in right here. My Wi-Fi is a little slow today. I apologize. But oh yeah, here. No other company besides them are allowed to sell any Coca-Cola products in these states. They literally own these states. If any Coca-Cola product is sold in any of these red territories, they collect a royalty from it. And so here are all the brands that they bottle for. They don't just bottle for a Coca-Cola. They're the largest bottler for Monster as well. But yeah, they bottle for Topo Chico, Powerade, Fanta, Monster, Core Power, Fresca, obviously Coke, Powerade, Dasani, Sprite, Minute Maid, Fairlife, which they actually said from GLP-1, this is actually growing in demand, this high protein chocolate milk. It's delicious. Vitamin Water, Mr. Pibb, Gold Peak Tea. So instead, you can own, I actually think this is a better way to invest in drinks than the main mothership Coca-Cola company. And the cool part is the share buybacks. I met the CEO. I've shaken his hand. I've seen his presentations. He owns 70% of the voting rights. It's a Christian value-based company. He has like a chaplain in all their bottling facilities. They return 2.5% of their before-tax revenue to the community. But that's how they're able to keep it Christian value. The CEO literally owns 70% of the voting rights. And that's why no analysts actually cover this one. But anyway, I love this one. They do buybacks. They have insane pricing power. The net income grew by 7, but the net income per share grew by 40 because of the share buybacks. Insane. Anyway, pretty cool company. Oh yeah, FAC. Yo, Glow. My bad there. Forgive me. I'm so behind on the chat. So he says Fractorial Energy stock. And hey, Lolo, thanks for that little gift there too. Yeah, thanks for the follow. I appreciate that. So Factorial Energy, it's a smaller one, so you do want to be a little cautious. They're only worth $620 million. But let's see what happened. Why are they at an all-time low? Are they a revenue-less startup right now? Yeah, so they are. So the last time they had revenue was in 2017, and they have no revenue. Like here, the forecast, there's zero revenue expected for the next 2 quarters. So I wish I could analyze, it's like we get they report net income numbers. They don't report current revenue because there is no revenue. Last time they did was 2017, but the net income, it's in 2026. So they lost 8 mil this quarter, 12 mil, 10 mil, and they look extremely leveraged. Look at that. That was the 2017 data. Now it's the 2026. They have 5 times more liabilities than they have assets. So I can kind of start to understand why the stock has done so bad. Nothing's really blowing me away here. I don't think they sell anything. I mean, they're losing money as well. And when you lose $10 million a quarter and you're only worth $600 million, that's a big chunk of your market cap. So here's their website right here. Batteries designed with a purpose. So they sell batteries. I know batteries are, there's a lot of companies selling batteries right now to drones as well. This is kind of a commodity. But let's see, top tier world class automotive partners, patents and applications. So look at that. Okay, they own 150 plus patents and patent applications. But still one I would be super cautious with. There might even be like some bankruptcy risk here. What are the short interests? No, actually not too bad. Hopefully that was kind of helpful there. I like that we went on their website. We found their patents and stuff, but I don't know about that. I don't know about they have no revenue yet. Oh, he says, can you check out the SPUS ETF? Okay, so this is the S&P 500 something exclusion. So yeah, there's some ETFs out there that literally buy the S&P 500, but like but they don't buy the airlines and the cruise lines, which are very in the oil stocks as well. They kind of get out of the cyclical kind of economic, like in a recession, these get crushed, like the airlines and cruise lines. But yeah, look at this. Their top holding is Apple, Nvidia, Microsoft, Google, Broadcom, then Micron, Eli Lilly, Tesla, AMD. So, I wonder what it excludes. Actually, let me see if we can get a description. They have a 0.45% expense ratio, so maybe I'd probably rather just go to the S&P 500. But the index, aerospace and okay, I don't know. Anyway, I wish I could give you better thoughts on them. Well, my Wi-Fi just went out. Well, I don't know if anyone can hear me, but Wi-Fi just went down. Well, hopefully the stream's back up. The kilobyte says it's recovering, but I don't know if I trust it. It's still a red box. Oh, geez. Sorry if you're watching the stream and it's lagging. I think we're good now. Okay, hopefully, as the screen is like lagging. Okay. Let's see what's next here. Oh, what's up? Okay. I'm so behind on the chat. Is 2DG, is that a stock ticker symbol? Hey, give me the ticker symbol for 2DG. I don't think it would have a 2 in it. Would you buy Moog right now? Dude, yeah, I looked up 2DG. Someone said, Gary, what's up, man? Good to see you. I typed in 2DG. I could not find it. I did look for it, though. Would I buy Moog right now? Moog just had literally gangbuster earnings. But I would not buy meaningfully right now, unfortunately, Ben. But yeah, this is the best, like they own the best patents. Every satellite that's sent into space, like the Voyager aircraft, uses their patented components. Every single satellite launched since in history uses their patented components. They own like the heat-seeking missile patent. They're one of the main suppliers for Raytheon, Lockheed Martin, and GE Aerospace. Huge military contracts and stuff. Unfortunately, because of the Strait of Hormuz and a lot of geopolitical war escalations, the stock is at a crazy all-time high, and they're at a very high valuation. So I would not buy meaningfully yet, but maybe I'd still, dang, the Wi-Fi. Yeah, the kilobytes are still cooked. Yeah, dang, I might have to end the stream here. That's unfortunate. But anyway, if this can load, yeah, I don't... So maybe someone's downloading a video game or something. Someone's downloading GTA 6 or something. I don't know what's happening. Okay, actually, it says we're fully back. Okay, it says we're fully back. So hopefully that's true. Yeah, look at this net income growth. They just had literally record net income. It's never even been close to this before. 152 million net income. Part of that was from a tariff benefit, the IEEPA tariff refunds. They benefited from that as well. So someone said UPS stock. Unfortunately, I would not buy this unless you just wanted to fully max out your dividend, because UPS is being out-innovated by Amazon. Like if you like UPS, you'd love Amazon even more as a superior business model, superior shipping logistics company. But yeah, if we zoom out, this stock is technically lower than their 2013 stock price. So you bought the stock in 2013, you're actually down on your money, which is, over a decade ago, 13 years ago. But you're basically buying this to max your dividend income. They pay a 6% dividend yield. So here's kind of the thing. you get its 6% dividend, then you kind of pray for 1 or 2% stock price appreciation on top of that. And historically, it really doesn't give much stock price appreciation. And actually, if we look, the dividend payout ratio says it's 100%. Let's go see if that's true. Um, and also, mm, and they might have had a one-time adjustment. It says they made 604 million. No, that's real. That's actually super concerning. So actually, let's zoom out. Normally, they make, if we average it out, let's say 1 billion in net income a quarter. Well, we'll say 1.1 billion in net income a quarter. Let's go see how much the dividend cost exactly. So the dividend cost exactly, dang, 1.36 billion. So even though they made 600 million net income this quarter, they actually lost 600 million because they had to pay out 1.36 billion in dividends. So, and look at that, for the past 2 quarters in a row, this is the only quarter where they've been able to afford the dividend. All the other quarters, like even back here, are less than 1.36 billion. So they're right. The dividend payout ratio is 100%, and it's even worse with this most recent 2 quarters. So that's why I'd be concerned. Yeah. Maybe it was a one-time adjustment, I don't know, but I'd be careful. I didn't mean to be too bearish, but I mean, all right. Figma. Okay, that's the Adobe competitor. At my college, like a lot, like people make apps and stuff using Figma. This one is just too far away from profitability. I mean, and there's the software sell off. Like maybe in 10 years from now, we won't need Figma as much. And actually, they look almost identical to Adobe stock. But maybe in 10 years from now, we can AI generate stuff instead of, you know, using their application. But look at these net income forecasts. It's actually really bad. They're going to lose 150 million next quarter of net income, 150 million the quarter after. So they're just like so far away from making any sort of net income. The revenue growth is great though. Revenue's up 46%, after grew 46%, after grew 42. So a nice streak of growth. But unfortunately, it's tough to value this one. There is no net income. Do they make free cash flow? They do make free cash flow. Okay, they have a decent bit of free cash flow, but there is no forward PE. And the forward PE would be like negative. Yeah, negative 24 times next year's net income. It's a tough sell. But Morningstar does say they're undervalued. Consistent product innovation, evolving pricing strategies, and a dominant market share in user experience design will drive long-term value growth despite near-term profitability pressures. Let's go to their website real quick. So yeah, anyway, I guess here's kind of their website right here. Anyway, yeah. Wish I could give you better thoughts on them. I just don't like the profitability issue. Um, what are your thoughts on EXTR? EXTR? Extreme Networks. Huh. I've not heard of this stock before. Let's check it out. Oh yeah, and then we'll try and cover NVIDIA before I go here. Dang, we've been live for over like an hour and 30 minutes. If you're enjoying, feel free to hit the like button and subscribe. I try and stream every day or every other day. So here, and I sell nothing. I have no course book. So it looks like 40% of the revenue is a subscription business. Analysts like that because it's all reoccurring, predictable, and yeah, their subscription business just hits a new record like every year. Their product revenue, though, does look like it's, well, let's go to the revenue. When we combine all the revenue together, yeah, the revenue is kind of lower than it was in 2023. And they're a bit leveraged. They have basically the same liabilities as assets. So are they profitable? So they are profitable. That's great news. Yeah, they're kind of not as profitable as they once were, but they're kind of fixing things again. So what exactly do they do? Maybe for communication equipment, infrastructure equipment, and related software. I wonder if there's some tailwind from data centers. They want my cookies. I guess here's their website. Get smarter and faster with Extreme Platform, fully integrated AI network platform. Okay, so they're not even really saying exactly what they do here. But anyway, some sort of like software company. I wish I could give you better thoughts on this one, but anyway, let's see the forecast. Yeah, they've beaten on net income forecast for the past 3 quarters in a row. Like they were expecting 4 mil, they did 10 mil, so that beat by 100%. Yeah, and they even beat on EBIT, so it was a real beat. They're supposed to lose 1 million next quarter, but then make 8 million, which is a nice increase. So basically, the net income's growing very fast. That's probably why the stock has done well. Technically lower than their, dot-com bubble price. So they've been public for a very long time, but the highest they've been in years. All right. Grab earnings today. Oh, our grab earnings today. Hey, I did not know that. Yeah, August 3rd. Yo, yeah, we actually just looked at this stock, so I really won't cover this one. I am actually really bullish on them. This is International Uber. They do exactly what Uber does, ride sharing deliveries, but not in the US or Canada. They do it specifically in these, international countries like, their top countries, Malaysia, then Singapore, Indonesia, Philippines, Thailand, Vietnam. So it's International Uber, and Uber is backing them. Uber is actually the largest shareholder. Uber owns 13% of all the shares. Toyota Motor owns 5.5% of all the shares. So, yeah, really interesting there. And they're finally super net income positive. So, yeah. Oh, McDonald's, I think earnings are tomorrow morning, or let's see. Yeah, you're right. Yeah, McDonald's. This is my favorite food stock to buy on the dip. And it's not just McDonald's that's on a dip right now, it's the whole QSR industry. Did you know Wendy's, RIP Wendy's, it's basically a charity. They are lower than their 1997's IPO stock price. You bought the stock in 1997, you're down over 50% on your investment. And it's not just them. Like look at Chipotle the past like year and a half. Like look at that. They were $66. Now they're $37. They're down 50%. And oh gosh, I could go through this whole list here. Jack in the Box, they are lower than their 2002 stock price. Krispy Kreme is lower than their 1990 stock price. Red Robin, I wonder if I can find Red Robin. Oh, dang, Red Robin is lower than their 2002 IPO. So it's not just a McDonald's problem. And actually, out of all the restaurant stocks to buy on the dip, I have been buying a bunch of McDonald's. I'll share with you my position. It's like my third biggest position. The best one to buy on the dip is McDonald's, even though it sounds boring, but their business model is actually fascinating to me. They're really a franchise model, which is a real estate and royalty company. So every franchise, or 80% of all the McDonald's stores you see, are franchises, and they have to pay 4 to 5% of every transaction back to this corporation, the parent company, as a sales and marketing royalty. And they also don't own the land under the store. McDonald's, this corporation, owns the land under all the franchises, so they collect rent and royalties from all these tenants. They said, the way to build an empire isn't to make 5 cents on every burger. It's to own the land and collect royalties and high margins. And they only trade at a 20 forward PE. They have a 2.7% dividend yield, and they have 30% plus net margins. No restaurant has 30% plus net margins, and that's because McDonald's is really not a restaurant. They're a real estate royalty company, and they are my second largest holding in here. I own 20 shares. It's a $5,400 position for me, and I am now down on my position. I am down 5%, so you could get in at a lower cost basis than me. Dude, we literally just looked at Figma the first time you said that stock, like literally 1 minute ago. So if you want, check out my YouTube stream. If you type in a YouTube Nathan Robert, you'll find my stream, and you can rewind it literally 2 minutes and find we just looked at Figma. Because most middle class people are poor today than they were years ago. Yeah, hey. Oh, what's up, Holy? Good to see you, man. I've been grabbing grab. Hey, Monkey D. Luffy. Nice, dude. Yeah, also, it helped me out. TikTok did just take down my For You page eligibility, so no new viewers will find the stream. So if you do want to support me, the best way to is just check out my YouTube channel. If you type into YouTube Nathan Robert, you'll find it. So what's up, GPT-1? Good to see you. GEHC looks good. GE companies carrying. What is GEHC? GE Healthcare. Oh, this is one of the spinoffs. So GE broke up into GE Veranova, GE Aerospace, and GE Healthcare. So I wonder, what do they own? Advanced Imaging Solutions, Pharmaceutical Diagnostics, Patient Care Solutions. Huh. So they're a medical device industry, maybe like an ISRG. Maybe if you can go to their website, find something. So they do ultrasounds, anesthesia delivery, imaging, maybe like they do the what are those called? The metal scan things. I forget, where you can't wear metal, whatever that's called. Maybe they make those devices. But yeah, they are cheap. They're only trading at 13.8 times next year's net income. And yeah, these net income forecasts are great. They're going to make 500 mil in net income next quarter, 700 mil the quarter after, with 10% net margins. Like if we zoom out, this is just consistent net income and profitability. So actually, I do like this one. Is there any news around them? Nope, no news. But yeah, it's hard to be bearish at a 13 forward PE. FICO stock. Yeah, so let's look at the FICO score. So every time you do a high ticket purchase, you buy a car or a house or something, you're paying a couple dollars for your FICO score. And they've had tremendous pricing power where people don't really care if you're paying $6 before, now you're paying, $11 for your FICO score. Whenever you're buying a $500,000 house, you don't really care. But They used to have a monopoly on the whole industry, but now the government has introduced Vantage Score, and that is not good. Wolf downgrades FICO on apparent and real Vantage Score competition. So that's the one bear case. Like, there's no fun. They're not missing on their numbers. Actually, they just hit their most profitable quarter ever. If we zoom out, that's so phenomenal. This net income growth. They're making over 200 million net income a quarter. It's kind of like an AI thesis where there's new competition and Vantage Score might take their market share away. Like, let's see here. Yeah, the FHFA decision to allow Vantage Score for government mortgages will alter its pricing strategy and could result in Vantage Score gaining traction in both mortgage and non-mortgage markets. Hmm. The government-sponsored entities may take their time to allow FICO and the direct license programs for the GSE mortgage. So, I don't know. So it's really just competition fears. Though honestly, we've known this for like years. Maybe the worst fears are fully priced in. They're only trading at a 23 forward PE or 23 times next year's net income. Yeah, they're going to be making in net income like 200 plus mil in net income a quarter from now on with great 35, 38% net margins. So yeah, their main business is their score business. And check out this growth over time. The scores are up 42, after grew 34, after grew 19, after grew 8. So nice little streak of growth. Still a good healthcare company is ISRG on its big dip. Let's look at ISRG. Yeah, ISRG. So yeah, they do the MRI medical scanning devices as well. This one is fascinating to me because of their literal monster balance sheet. If we go to their balance sheet right here, they have literally zero debt. They're completely debt free and they have 5 billion of cash. And that cash isn't just sitting there doing nothing. They're milking it in 1 to 3 week treasury bills. So they earn interest on it. A lot of companies have a lot of debt and this number is negative because they're paying interest. This company has so much net cash because they have no debt and 5 bill of cash. They're making interest on it. They make $82 million just this quarter in interest, and that goes straight to your bottom line. And check this out. If we zoom out, this is their most profitable quarter, most profitable year ever. I love this net income growth the past 2 years. They're making like 800 mil of net after-tax net income a quarter with like 30% net margins. So yeah, they sell the instruments and accessories for the medical device industry, and they also service them as a nice reoccurring business that grew predictable, reoccurring. It's up 20% after grew 23, after grew 10. So I'm really impressed with them. Unfortunately, the only slight bad part is even after this huge dip right here, they're not cheap. Like they're not cheap. Like they're probably fairly valued right now. They're trading at 38 times next year's net income, and again, they deserve a premium valuation for their balance sheet and growth like that. But the weight loss prescription. Okay, Morningstar says they're reasonably valued. Its unparalleled install base and the robust rollout of the DaVinci platform ensures long-term market dominance, while moderating procedure growth and pressures from weight loss prescriptions warrant a balanced perspective. So maybe, I don't know if they cater to, if some of their machines come from diabetes or something, I don't know. Maybe their treatments will go down if there's like a healthier trend. I have no idea. So I still love this company though. Monster balance sheet. What was the bad news? So procedure volumes grew 16%. System placement increased significantly with 468 DaVinci systems deployed, including 250 next generation units. Anyway, hopefully that was kind of helpful there. I hope the parent company gets a small fry and a Diet Coke. I favor McDonald's because it appeals more to kids who are not adult, normally on GLP-1. Yeah, McDonald's, oh, that's actually a great point. McDonald's also finally brought the value back. If you go on the McDonald's, or you don't even have to have the app. They have a $5 meal deal where you get a McChicken, a small drink, a small fry, and 4 nuggets. It really is the best everywhere. There's no restaurant that can really beat the $5 meal deal. They're finally bringing the value back, and they always do cool sauces and innovations, and they're always doing cool stuff. And now the Happy Meals are really cool. Do you know where I can buy a funded account to trade stocks? I don't know. I'm not sure what you mean there, but no. I mean, if you're just talking about a brokerage, if you're looking to buy stocks, and I'd get this brokerage right here. You're able to take out margin, but I don't ever recommend taking out margin. You're basically taking out debt to buy stocks. And I wouldn't even trust myself. You take out debt for an 8% interest. Well, you got to beat the S&P 500's 8% a year. So it's like hard to, anyway. I love, this is my favorite brokerage to buy and sell stocks on. It's better than Schwab, E-Trade, and Webull and Robinhood, I think. It's linked in bio if you want to get it. Brokerage called Moomoo. Anyway, let's do Autodesk. ADSK. What's up, Yan W? Good to see you. Oh, and then we can try and get to Celsius and MCore, dude. Yo, Eric, my second most recent YouTube video was a huge deep dive into MCore. And literally the day after I made that YouTube video, they went up 18%. And I made that video less than a week ago. If you want super deep dive analysis, check out my second most recent YouTube video. If you type into YouTube Nathan Robert, you'll find it. So here's, and we might cover that as well. They're still super undervalued in my opinion. So here's Autodesk right here. This is, I don't know what they are, but they're lower than they were 5 years ago. They're lower than their 2021 stock price. So they do architecture, engineering, and construction operations. It's half the revenue. AutoCAD, looks like this is mainly, like the US is only 35% of the revenue. Let me go to their website. I'm not too sure exactly what they do. Autodesk for small businesses. Discover our affordable 2D drafting and 3D modeling and 3D printing. So, maybe they like help you, literally engineer and construct your projects. I wish I could, spend more time deep diving into this one, but affordable 2D drafting, 3D modeling, and 3D printing software for small businesses and professionals. So, that is interesting right there. Let's see what the revenue growth is. So when we combine all their businesses together, yeah, revenue's growing very nicely. Revenue's actually at a record. Revenue's up 18.5% year over year. After grew 15, after grew 11. So nice little streak of growth. And they are profitable. Wow. They're actually making hundreds of millions a quarter. That's actually fascinating. They're easily, if you average it out, they're making like 350 million of after-tax net income a quarter. Yeah, they're going to make 400 mil next quarter, 423 mil the quarter after. So they're going to stay super net income positive, and they're beating on expectations every quarter as well. That's probably why they have done good. I don't know. And they're at a 28 forward PE. I mean, that's fair for the growth that they have. So, that's Autodesk. Hopefully that was kind of helpful there. So MCore right here, yeah, this is the company doing the complex MEP work for data centers, just like Comfort Systems, my largest holding. Comfort Systems had to sell off a bunch of its subsidiaries to MCore back in 2008 just to stay afloat. But yeah, if we look at this stock price right here, a lot of people see this rally and they're like, okay, this stock's unbuyable. The rally's already over. They got to be really expensive. They're really not. The earnings have kept up with the stock price. So to the point where they only trade at a 25 PE ratio. For context, the S&P 500 trades at a 28 or 26.5 PE ratio. They're literally cheaper than the S&P 500 with better growth, in my opinion. Net income's up 33, after grew 22, after grew 79, after grew 39. So yeah, they do, for the US, they do the complex MEP work, the complex mechanical, electrical, and plumbing work for data centers. Yeah, 24 times next year's net income. Honestly, don't trim or sell that stock. It's just going to continue to climb higher, I believe. So let's do Celsius real quick. This is your energy drink company. There is some new competition. Like the day Costco made like a Celsius knockoff, they fell. And Body Armor now has Body Armor Fit, which literally looks like a replica of Celsius. But yeah, you've probably heard of these drinks before. They actually have a 20% energy drink market share. I want to share with you that right there. So they have the number 3 energy drink portfolio and a 20% market share in the US. They also own Alani. I see those everywhere at my college. The Alani energy drinks as well. So yeah, it says they trade at 65 times net income. That's actually not true. It's way lower. They had a one-time adjustment. They actually only trade at 17 times net income, which honestly I believe is undervalued. Yeah, here's how you know. It says they lost 61 mil this quarter. They didn't actually. They actually made 160 mil. They had a one-time adjustment, one-time gap accounting trick because they moved their distribution. They terminated their old one and moved it over to Pepsi. So there's actually Pepsi. Oh, and part of this deal, Pepsi gave them Rockstar Energy. You've heard of that before. So Celsius also owns Rockstar Energy. Pepsi gave them that for free. It's part of the distribution agreement. So even Morningstar says they're undervalued. Strategic expansion through the PepsiCo distribution partnership and the diversification from the Alani acquisition will drive long-term value growth despite a highly competitive environment. Like they got Monster, Body Armor. There's a lot of other drinks out there, but actually I like this one. They report earnings in a couple days on August 6th. Pretty interesting there. Yeah, I've actually been really wanting to try the Body Armor like Live Fit. I wonder how everything Body Armor tastes super good. I'm probably biased though because I own Coca-Cola, which owns Body Armor, or Coca-Cola Consolidated. But yeah. What are your thoughts on? All right, INFY. Ask the guy who ran situational awareness about using debt leverage to buy stocks. Yeah. ISRG is a razor blade type of company. The servicing and suppliers are very high margin. Your supplies, yeah. ISRG is really fascinating. Actually, we're not going to cover this stock. Oh wait, I typed in the wrong ticker symbol. Thank goodness. I was like, that looks weird. Oh, Infosys. Okay. Wasn't this company going to get bought out? I'm probably thinking of something else. Anyway, unfortunately, this stock is lower than they were in 2020. Huh. So if you bought the stock in 2020, you're slightly down in your position. They do financial services, manufacturing, they're an energy utility company, retail, communication, life sciences. They are very diversified. They're in a lot of different industries. 60% of the revenue is North America. When we combine all the businesses, though, the revenue growth is starting to slow down. Like the revenue only grew 2.85% year over year. So that, that barely beats inflation. That's like low single digits right there. So when we zoom out, yeah, the growth hasn't been amazing, like low single digits. What about net income? The net income is super solid. Like there's no bankruptcy risk here. But yeah, even the net income, it's the same as it was in 2021. That's why the stock is having a tough time, escaping this market cap level. Nothing justifies it to escape a $50 billion market cap when they're making the same net income as they did 5 years ago, or very close to it. Yeah. Anyway, there's definitely no bankruptcy risk here, and they're printing 800, 900 mil a quarter. But I think the slow growth is why they're trading so cheap. They trade at 15 times net income, which is really way lower than the market, but that's because of the slower growth. Oh, they have a nice dividend yield of 4.27% dividend. So you get basically 4% of your money back just in a qualified dividend every year. Huh. But not much stock price appreciation. So we'll look at a few more here. Then I gotta go. Sadly, GoPro stock. Yeah, don't buy GoPro. The Chinese camera have taken over GoPro. They just sell a commodity cameras, and anyway, this stock is at an all-time low for a reason. This is why looking at financials is so important. There's a ton of stocks to buy on a dip. I would not buy this one on a dip, or actually, I wouldn't buy it at all. So the whole company is worth 129 million. So it's a micro cap at this point. The whole company is worth 129 million. Think about this logically. You could buy the whole company for that price. You could buy the whole company for 129 million. Let's say you do it. You bought a company that literally just in the past quarter lost $80 million. So there goes over half of your investment instantly. The previous quarter they lost 9 million, 21 million, which even losing 21 million, that's 18% of the whole company. 16 mil, 46 mil. I mean, stocks don't just look this bad for no reason. There's a real fundamental deterioration. Let's see what the short interest is. Yeah, 13% of all the shares are being shorted. That doesn't just happen for no reason. There's real bankruptcy risk here. And sadly, I would not buy that one. Hopefully that was helpful though, because that's how I approach stocks. Like there's a reason like certain stocks like Google are at an all-time high, and then you see stocks like GoPro and Lucid that are at all-time lows. It's purely off the financials, and that's why I focus on them so much. Like look at Lucid. The whole company is worth $3 billion. So you could buy Lucid for $3 billion if you wanted to. Hey, if everyone pitches in a dollar, let's do it. But no, listen, if you buy them for $3 billion, you bought a company that literally this quarter lost $1 billion. 800 mil the quarter before, 900 mil, 500 mil, 300 mil. They're literally losing like $1 billion a quarter with more liabilities than assets. So that's why I specifically focus so much on financials. It really moves the stock. Groupon, yeah, I would not buy Groupon either. They also the fundamentals have just deteriorated over time. Are they profitable yet? I don't know. But they used to, like if we just zoom out on the revenue right here, again, stocks don't just fall for no reason. I mean, we could look at this revenue decline. They used to do 800, 900 mil of revenue a quarter. Now it's like, geez, dang, it's only 100 mil a quarter. And look at that growth rate. It only grew 0.01. So that doesn't beat inflation. And they have a lot more liabilities than they have assets. It's a tough sell for me. Let's see, they're like not losing that much money. I mean, really, I still wouldn't buy them. Dude, try not to spam there. That's not cool. Hold on. I gotta, yeah, Groupon, nothing's really blowing me away here. They're very leveraged. The revenue's not growing. But maybe they can have a comeback. I don't know. But yeah, not one I trust a lot of money in. Hopefully that was kind of helpful there. So, all right. Okay. Have we done? All right. We'll end it off with like, yeah, we'll do Micron. I saw SanDisk. So I have the same thesis on Micron and SanDisk. These short term, medium term, it is very hard to be bearish. And honestly, I'm even considering having this one as like a small position, but not anything bigger than a small position, and if I would buy it, it would be for a short-term, medium-term trade. I think they're going to do good for the next 2 years. Look at this forward PE. Like, this doesn't seem like some peak bubble valuation. They traded 18 times net income and only 5.7 times next year's net income. I feel like this could stretch up easily to like a 7, 8, 9 forward PE before it fully maxes out, and that sends the stock up over 50% back to an all-time high. But it's the long-term thesis, the 2028, 2029 numbers that are scaring me. That's going to be peak ever net income. They can't sell a commodity RAM at a 68% net margin forever. And that's where Morningstar kind of is bearish. But I'm not this bearish, but here's what Morningstar's saying. And it does make sense. They say they're overvalued, while the AI-driven memory pricing upcycle and soaring high bandwidth memory demand provides robust near-term tailwinds, but the inherent commodity-like nature of the industry and a looming risk of a steep cyclical downturn driven by future capacity overexpansion requires significant caution. So that's why I would not buy and hold this one permanently, but honestly, it's a decent short-term swing trade. Um, hmm. Looks like this is actually China's most valuable company now. I couldn't believe it. CXMT, it is China's highest stock by market cap. It's their biggest company ever. They just planned a second memory chip plant after their IPO, expanding challenge to Micron. Anyway, that's no big deal though. Apple CEO warns of DRAM price surge as a 100-year flood. Highlights oligopolistic memory market with only 3 suppliers. Huh. Anyway. Michael Burry, oh my goodness. Michael Burry expands short position in Micron and Nvidia, warns of infrastructure bubble and 30% semiconductor correction. It's hard to claim a huge bubble when, Micron's only at a 5 forward PE, Nvidia's at a 20 forward PE. It's hard to be bearish. So yeah. Bro, Micron buy or no? I would buy Micron as a short-term trade, but not as a buy and hold stock. And that's why I'd be so cautious. I really wouldn't own it meaningfully because of but again, it's like they'll probably do good through the next year or two on these great earnings. Ah, um, do we want to look at another one? Okay, Meta's up 6%. Yeah, Meta is up 6%. They have just been too cheap for too long. I've been saying this, like, I just actually made a video on them yesterday. Meta yesterday was at like a 17 forward PE. I'm like, I don't see Meta getting much cheaper than a 17 forward PE. I could not see Meta at a 15 or a 16 forward PE. That would be just so weird. Morningstar says they're undervalued. Aggressive AI-driven improvements in its advertising ecosystem, unparalleled global network effects, and the potential to monetize surplus compute capacity will drive long-term value growth. They're now renting out their excess GPUs, which is new competition for like a Nebius and a CoreWeave, because it's a commodity. They can, but yeah, Meta's still undervalued. I would, if I was up, I would not sell that one. Oh, watch out for these people in chat here. Hold up. Okay, let's do Eli Lilly here. This is the last stalker. Nvidia, please. Yeah. Speaking of Nvidia, here's the thing. I'm also really bullish on Nvidia. A lot of people see this chart and they're like, Nvidia's done. There's no more upside, but I disagree. Nvidia only trades at 20 times next year's net income. That's why Michael Burry's stupid. This isn't some peak bubble valuation. It's nothing like the dot-com bubble. 20 times next year's net income is actually cheap. Even Morningstar saying they're undervalued. Exponential growth in data center capex, high switching cost from its proprietary CUDA software, and continuous AI innovation will drive long-term value growth. They're selling these chips at a 63 to 70% net margin. So for every $100 that comes in, they're keeping $65 after tax. Like, they're basically collecting royalties. Revenue's up 85%. This is the purest AI picks and shovels play. And even though they've had this crazy rally, in my opinion, they're just going to continue to climb higher. Nvidia should be trading at like a 25 forward PE or 25 times next year's net income, not a freaking 20. And they just rose their dividend by a big chunk. Anyway, yeah. Great business. And then last up, what was it? Eli Lilly, please. Yeah, this is a huge weight loss prescription company. What is this right here? This article. Eli Lilly receives US FDA breakthrough therapy for the treatment of previously KRAS mutant advanced pancreatic cancer. So anyway, that's good news. They got FDA approval. Oh yeah, received second FDA breakthrough for their. Okay, any other news? Anyway, They just had great earnings. Their two main weight loss businesses, Mounjaro, grew 125%, and Zepbound grew 80% year over year. It is ridiculous. This stock deserves to, like, this chart is justified. They deserve to be doing this good. If we just zoom out on the revenue right here, this is all organic. Like, they didn't acquire a company. This is organic. Revenue's up 55% year over year. After grew 45, after grew 25. So incredible growth on their business, and not just the revenue, but also the net income. They had the most profitable quarter ever in history. So yeah, it's hard to be bearish. I mean, this is a triple digit net income growth. Revenue's up 55. So that's pricing power. Yeah, the net margin went from a 21 to a 37. So for every $100 that comes in, they're keeping 37. They're going to do 8 billion in net income in 2 quarters. That's going to be their most profitable quarter ever. You get a 0.5% dividend yield there. So yeah. So here's the AI outlook. The AI earnings outlook. The company's forecasted to sustain strong momentum with over 30% revenue growth and 40% EBITDA increase. Key drivers include the GLP-1 product, new obesity treatment launches, and expanded Medicare access. So yeah, interesting there. It's probably a little overvalued right now. Oh yeah, what's up, Eric? I'd love to hop on a call. Hell yeah, hey, send me a DM. Yeah. Well, anyway, guys, that was the streamer. Intel, please. All right, fine. Intel, and then I'll get out of here. I'll get out of y'all's hair. NVIDIA just bought a bunch of Intel. The U.S. government just took a 10% stake in Intel as well. We have this valuable technology of chips, and they're all manufactured 6 feet away from China in Taiwan. And, you know, we don't want China really having access to our chips. So we need to be more manufacturing independent. So the government took a stake in Intel, and NVIDIA agreed to move some of their manufacturing away from Taiwan to Intel. Google just announced they're moving some manufacturing to Intel, which is great news. That's part of their way. All these U.S. companies agreed to spend hundreds of billions of dollars in the U.S., and part of the way they can do that, and they get tariff exemptions, part of the way they do that is to move manufacturing to Intel, which creates a huge velocity of money effect, creates jobs and stuff. But anyway, Intel, they're also owned by NVIDIA. They have a big stake. The only little scary part is like these net income. They're still like quite far away from making consistent net income. Ever since they lost the Apple deal, you know, this is when every Apple chip or every Apple iPhone and computer had an Intel chip. And now, ever since, the net income has looked very choppy. But there's also a big CPU shortage. One of the huge reasons Intel's doing so good is because of their CPU business. So about 2 years ago, in data centers, for every 8 GPUs, you would need 1 CPU. Now, for every 2 GPUs, you need 1 CPU, and it's not just Intel that's had this huge rally because of that. It's AMD as well. AMD, like specifically this little 2-month span right here, Intel and AMD both had this crazy rally because of that news. And anyway, the tough part is like there is a forward PE. Okay, so they trade at 76 times next year's net income. You know, that might still be a little expensive, 76 times next year's net income. Morningstar says they're fairly valued. Robust demand for server CPUs driven by agentic AI and steady progress in its foundry manufacturing nodes will support long-term value recovery. Intel reports fastest revenue growth in 15 years, issues strong demand for data center AI surge. So interesting there. What did that say about the CPUs? Server. Okay, anyway, yeah, that was the stream. Thanks for breaking this down. Yeah, hey, no problem there, user. Hey, if you did enjoy and want to support me, there's only one way to support me, and that's to subscribe to my YouTube channel. I sell nothing. I have no course, book. I'll never follow you, DM you. Watch out for people impersonating me. I sell nothing. The only way to learn, if you wanted to, is check out my YouTube channel. I'm trying to build up my subscribers over there, so just type into YouTube Nathan Robert. You'll find it. Thanks again. Have a great rest of your day. I appreciate everyone that's here. I try and stream every other day, so hit the follow button if you'd like to. No pressure. Oh, and if you want to get this app I'm on, best brokerage in my opinion, linked in bio, my favorite app to buy and sell stocks on. And it's actually useful to analyze stocks on. You get the cool, if your net worth is over $100 million, you buy SEC Loft to disclose all your trades. So we get all these super investors. They have really cool data like the interest rate, macroeconomic data. Oh, in one stream, I want to just go over all these sectors right here. I want to find what are the best stocks from all of these different sectors right here. We already know a lot of these, but there's a lot of cool sectors that I don't really have exposure to, and maybe we could find some cool new stocks just by going through these lists here. Oh, and the macroeconomic data is cool. So here's why a lot of interest rate sensitive stocks are struggling. On the October 28th meeting, did you know there's over a 56% chance that interest rates are going to be risen by 25 basis points and a 20% chance of a 50 basis point hike? So a 70% chance of rates going up on the October meeting. Standing some stocks down. What's the app? Yeah, hey, it's actually a brokerage just like Schwab, E-Trade. If you want to get this brokerage I'm on, it's called Moomoo. I have an affiliate link linked in bio. It's free, costs nothing. Thanks again. See ya. Oh, and linked in the YouTube description too. Thanks again, Mustin and Dragos. Oh yeah, and John Bradford. Thanks for being a member, and Sam Moday. Oh, if you become a YouTube member, you also get permanent access to my Discord. So yeah, if you become a YouTube member, even if you cancel your YouTube membership, you stay in the Discord forever. It's really a great community. You know what? I'll pull up the little thing here. I already ended the TikTok stream. I never promote this because I never like to like I say I'm selling anything, but literally it costs one singular dollar to join the Discord, linked in description, or if you become a YouTube member, you get permanent access. Thanks.